looking at for a while.
Yeah.
That's certainly an appropriate thing to look at.
Yeah, because it's just going to continue to happen, is my opinion. It doesn't have to be yours, but it sure the heck could have helped here if they knew they were going to walk away, if they could walk away with not the bonuses, the compensation. I mean, they made money, a significant amount of money for their bank failure. Last question, Chair Powell. Do you believe that the impacts of climate change pose a risk? Have you been talking about that more?
I certainly believe that climate change is real and poses risks over the longer term, sure.
So there have been some that say, you know, higher interest rates it actually makes it more difficult to build out the renewable energy projects and other investments required to prevent climate impacts. Do you believe that to be true?
You know, it's not our, I believe that we need to do our job that you've assigned us, which is maximum employment and price stability, and we do it through interest rates. It's not our job to consider the effect on climate change of that, and I think any effect on climate change of that would be kind of minuscule.
Okay. Last question, Chair Powell, who do you see as the major winners and losers from high interest rates in terms of income groups, age groups, and racial or other demographics?
So the point of high interest rates in the current environment is to bring inflation under control. The people who are hurt the most by inflation, as you know, are people who are on a fixed income, who right away are in trouble when the cost of transportation, food, energy, and when those things go up, they don't have financial resources to deal with it.
Have you looked
We're
at
accountable to provide price stability to the American people. Those people benefit the most over time from stable prices.
Gentlelady's time's expired. We'll go to the gentlelady from Missouri, Ms. Wagner, for 5 minutes.
I thank you, Mr. Chairman, and I thank you, Chair Powell, for your service. I want to associate myself with the comments of my colleague, Mr.
Fed Chairman Jerome Powell testifying before the U.S. House Financial Services Committee in Washington, D.C.
And I do hope that the Fed is doing everything it can to ensure that the exposure that these banks have will continue to be, in your words, manageable, because this is a looming crisis out there, given the workplace changes and dynamics. Chair Powell, in remarks on Bloomberg, Larry Summers, former Treasury Secretary during the Obama administration, stated that, and I quote, "It would be much more productive for our central bank to be focused on the question of real estate portfolios in the banks they supervise than, quote, some of the more abstract and politically driven arguments about various kinds of capital charges on the largest banks." Do you agree, sir, that it would be more productive for Fed supervisors and regulators to keep their eye on the ball, in this case, commercial real estate and other real estate investments?
I absolutely think we need to keep our eye on the ball on commercial real estate, and I think we're doing that.
I hope so. According to your semi-annual report, the median of members on your Monetary Policy Committee estimate that your target overnight interest rate will average 4.1% in 2024. Does that mean that the median number of members anticipate that you will be cutting interest rates sometime this year by as much or more than a full percentage point?
No, it doesn't mean that. Actually, the Summary of Economic Projections showed a median of, this is in the December FOMC, so this is now 3 months old, showed 3 rate cuts this year. So that would be 75 basis points, 3/4 of 1 percentage point. You were quoting the next year's number, so you would add that on. That was through 2025, I believe.
So are you anticipating that there would be more cuts? So what you're coming?
It's not, the way I would say it is, we're making economic projections. And so we write down a path of growth, what's happening in the labor market, what happens with inflation, and what goes with those forecasts is an appropriate monetary policy, appropriate interest rates. So we expect inflation to come down, the economy to keep growing, the labor market to remain strong. And if that's the case, it will be appropriate for interest rates to come down, significantly over the coming years.
Good.
What will really happen, though, it's not a plan. What will happen is actually what the economy needs. The economy will do something different from that, and that's what will actually happen.
Chairman Powell, 15 members of Congress, including myself, Ranking Member Sherman, Chairman Barr, and Ranking Member Foster, sent a letter to the prudential regulators regarding the impact that Basel will have on U.S. capital markets activities. The letter highlighted critical areas of our U.S. markets, including securities underwriting, securitization, and derivatives that will be severely impacted by the Basel proposal. This was also a common theme represented throughout the comment file on the Basel proposal, over 95% of them. Considering that 75% of financing in the U.S. is done through our capital markets, which are the deepest and most liquid in the world, why would the Fed continue to pursue this flawed proposal instead of re-proposing a rule that would not have such a drastic impact on the U.S. economy?
Well, in fact, the capital markets concerns you raised are among those that I raised myself in our open board meeting when we put this out for comment.
You said you wanted broad support, and obviously there is dissent among some of your governors, the FDIC, others. So how are we coming on this, and how are we
So we're working our way through the comments, and we're coming to the point where it'll be appropriate for us to begin to evaluate what changes are appropriate. I've said I think those changes will be broad and material, and that's where that is. But we haven't made any decisions yet. We just got the comments.
In my role as chairman of the Capital Markets Subcommittee, I have seen SEC Chair Gensler push the envelope in terms of rules and regulations that go well beyond the congressional mandate, even encroaching on the jurisdiction of other financial regulators. What is the Fed's response to another agency encroaching on its jurisdiction?
We do not comment on other agencies' regulation. However, if they were actually, to take your hypothetical at face value, if they were to come into our jurisdiction.
Oh, it's more than a hypothetical.
And we would react.
Good. Well, I hope you do. I yield back.
Gentlelady from New York, Ms. Velasquez is recognized for 5 minutes.
Thank you, Mr. Chairman. Right here.
Hi.
Hi. Thank you for being here, Chairman Powell. Property insurance rates are becoming prohibitively expensive or inaccessible for homeowners and developers in my community. The FSOC's annual report identifies property insurance rates as an increasing risk, and I recently raised this issue with Secretary Yellen. Is the Fed monitoring the rising cost of insurance and its impact on macroeconomic?
We are listening to Fed Chairman Jerome Powell testifying before the U.S. House Financial Services Committee. Seems like we have lost the audio feed, but not to worry, as we are here. So again,
The clock being frozen is out of respect for Ms. Velasquez, or out of good luck, I'm not sure.
The clock.
But we'll get staff to listen. We'll just suspend for a moment.
We need to invest in infrastructure for this committee.
Yes. Well, we're trying to do electronic voting, and
Not voting.
no, it's hard enough to just get the microphones to work. Madam Clerk, thank you. Thanks. So all the photographers have left, so the awkward photos for Trish will be less awkward.
all right. So again, looked like having some technical difficulties down in Washington, D.C. No surprise, as they get their shop in order. We'll do a quick reset here and get a data check with Mr. John Tucker.
Yeah, and after yesterday's sell-off, Paul, the major stock averages are higher, but right now off the best levels of the session. Jerome Powell is expected, reiterating the Federal Reserve no rush to cut interest rates. If there are any surprises, it should come up during this Q&A session that you're hearing with the House lawmakers. And for once, it's not our technical problem. It's actually in Congress. And I like Nydia Velasquez's comment there. We need to invest in infrastructure in the hearing room. Traders also weighing the latest labor market readings. Job openings remaining elevated in the month of January, so that suggests demand for workers is still strong. That's the JOLTS job opening labor turnover survey that we got at 10 o'clock. Available positions edging lower to 8.86 million. Among some of the individual stock movers, NVIDIA shares, they are higher, up 2.6% right now. And you also have Tesla shares, they're down about 2.4%. CrowdStrike Holdings, that surged earlier today, and right now up almost 11% on a bullish forecast if their earnings report. S&P 500 overall 38 points higher. That is up 0.8%. We're at 5117 on the index. The Dow Jones Industrial Average is up 0.6%. We're at 248 points higher. That's at 38,833. The Nasdaq 100 up 157 points. That is a rise of 0.9%. The two-year yield 1 basis point lower, as we hear from Jerome Powell. That's at 4.54, and then the benchmark, the 10-year. That is right now 3 basis points lower. That's at 4.11. And we check the markets all the time right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash as we continue with the testimony before Congress, the semi-annual testimony of Jay Powell, the Fed chair. Alex and Paul.
Yeah, John Tucker, thank you so much. Just kind of watching the feed here, the audio feed. Apparently they had some technical issues, it appears, with Fed Chairman Jay Powell's his microphone, so they've switched them out, and I think he's back up and running. So let's head back down to Washington, D.C. Fed Chairman Jay Powell testifying before the U.S. House Financial Services Committee.
Insurance, including property insurance, and it's been adding meaningfully to inflation. It's not something we have any control or authority over. Same is true of auto insurance. They're just insurance generally prices have gone up a lot.
So when we talk about the lack of affordability when it comes to housing, the insurance, the rising cost of insurance is an important factor that is affecting the availability of affordable housing in our communities. And I hope that there are some discussions among the Feds, because it is an increasing risk, and it's going to have a direct impact on our economy. Chairman Powell, I know you spoke with Chairman McHenry a little bit on inflation and interest rates. Can you explain what evidence you're looking for before inflation has returned to 2% and interest rates can be cut?
Sure. So we're not looking for inflation to go all the way down to 2%. That's not what we're looking for. What we want is just more evidence that will give us more confidence that inflation is on a path down to 2% sustainably. So that will come in the form of good inflation readings, really. We want to see, just a bit more evidence so that we can be confident. We don't want to have a situation where it turns out that the 6 months of good inflation data we had last year, that didn't turn out to be an accurate signal of where underlying inflation is. So we're just being careful, and because the economy is so strong and the labor market's so strong, we think we can and should be careful as we approach that decision.
And when you say evidence, what evidence? If there's anything?
So just more, we'd like to see more good, relatively low inflation readings. We're not looking for better inflation readings than we've had. We're just looking for more of them. And what will happen is as we go forward, the 12-month inflation will continue to drop because it'll be lower than early last year.
Thank you. Mr. Chairman, I would like to pick up on where Ms. Tlaib left off and reiterate the importance of the rulemaking on Section 956. This is an issue that I also raised with Vice Chair Barr, Chairman Grunberg, Acting Comptroller Sue, and I told them when they came before this committee that I will be asking for a status update on the rulemaking at every future hearing, because it's well past time, 12, 13, 14 years. If you are employed in a company and you are given a task, I will think that you will be fired if you don't get it done, and it has taken 12 long years. So you are the chairman of the Fed. How is the Fed working with other agencies to propose the rule?
So there's a lot going on in regulation at the Fed right now. My understanding on 956 is that there have been discussions between the regulatory agencies, and I think it's not 3, I think it's more like 6 agencies that have to agree.
I know.
I have not seen a proposal. I think something is under consideration, but it's not something that's gotten to me yet.
I will ask the next time, and believe me, I'll be here.
Great.
Thank you.
Gentlelady yields back. Gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Mr. Chairman, good to see you. You have said numerous times that the capital framework is about right and that banks are well capitalized. Do you still believe this?
I do.
Given that you believe that, and given the fact that the Basel III Endgame proposal dramatically increases capital requirements on banks, would a reproposal that implemented Basel III in a capital neutral way, could it do so without jeopardizing financial stability?
Could. I mean, hypothetically, yeah.
Okay. According to Latham and Watkins, 97% of the comment letters either opposed, called for a reproposal, or expressed substantial concerns about the Basel III Endgame proposal. And those negative comments came from across the ideological spectrum and from various interests. Without objection, I would ask the chair to include that report into the record. Without objection, I'd ask the chair to include that report.
Without objection.
Thank you. And Mr. Chairman, did you see that report?
I did.
Does that concern you, that 97% of the comments were negative?
So we didn't do our own count, so I can't make an assessment, but I would say it's unlike anything I've seen.
The Basel III comment period ended on the same day as the Fed's data collection on the proposal, which is an odd process since the data should have been collected far earlier, analyzed, and the results should have been available for the public to comment on before the comment period ended. Why did the Federal Reserve choose to do a quantitative impact study during the comment period for the proposal, foreclosing any ability by the public to comment on the results of the study?
Well, I mean, the movie's not over. We are where we are, and Vice Chair Barr did commit to putting the QIS out for comment. We will receive those comments, and those comments will be taken into consideration as we think about the path ahead.
Well, speaking of process, you've got your excellent general counsel right behind you there, and I don't want to get into privilege here, but have the lawyers at the Fed raised any process concerns or Administrative Procedure Act issues with the board?
Let me just say that we're committed to doing transparent and reasonable and data-based rulemaking in compliance with the Administrative Procedure Act.
Well, of course, giving the public the ability to comment on the quantitative data that has been provided obviously is consistent with good process. Sir, Governors Bowman and Waller, Vice Chair Hill, and Director McKernan all dissented on the proposal, and Vice Chair Jefferson expressed concerns with it during his statement. Under your tenure as chair, can you identify any other regulatory proposal which has elicited this much dissent?
No.
Have you in the past acknowledged in front of this committee that you will not move forward with proposals without consensus, or you have acknowledged that in the past, and we appreciate that commitment to consensus. Have you achieved consensus yet on the Basel proposal?
Let me say I am confident that we will, but that's a process that we're as I mentioned, we're evaluating the comments. We're just coming to the place where we're going to start talking about the path ahead. And I am confident that we'll achieve very broad support on the board.
Mr. Chairman, do you agree that the heterogeneity and business model diversity within the banking sector contributes to system-wide financial stability?
I strongly do.
And do you agree that a concentrated business model in the banking sector would present a potentially systemic risk?
Potentially, yeah.
And this is one of my major concerns with the proposal, Mr. Chairman, because by de facto repealing regulatory tailoring, subjecting Category 3 and 4 regional banks to one-size-fits-all standards that currently only apply to large GSIBs, discouraging securitization, which is the private sector solution for dispersing risk, eliminating the use of internal risk models, and transitioning the industry and regulators toward only a standardized framework, actually would push the industry into a smaller and more concentrated looking industry, and as a result would, in my view, actually increase systemic risk and decrease market competition. Do you share that concern?
I think it's a real concern. And again, I think that's part of what goes into my thinking, certainly about the proposal and where it needs to go.
Well, given all of these concerns, we hope that you can commit to reproposing the Basel III endgame, and we strongly urge you to take that into consideration. With that, Mr. Chairman, I
Gentleman from
appreciate the
Massachusetts,
time.
Mr. Lynch, is recognized for 5 minutes.
Good morning, Mr. Chairman. Welcome. Good to see you again. I want to go a little deeper into the commercial real estate issue and the potential impact on regional banks. This morning, Scott Rector, who's a member of the New York Fed Board of Directors, released a white paper on CNBC this morning describing the trillions of dollars in commercial real estate loans that will come due over the next couple of years. He described it as a, quote, slow-moving train wreck, close quote, and for our regional banks. He went on to predict that it will force between a little over 500 banks, thereabouts, to either fail or consolidate. He also described what he termed as a doom loop where, similar to Silicon Valley Bank, when people lose confidence, when depositors lose confidence in the bank, they pull their money out and we end up in a bad situation. Now, I don't believe everything that I read or hear, but in Congress we do tend to repeat it. And I just wanted to get a sense from you. I am seeing in my own city of Boston, we've got 20% vacancy rates in office space. We rely on that for a lot of the tax revenues for the city. But I'm just wondering your thoughts on that issue. Is there a systemic concern here, or is this isolated? And might lowering the interest rates help some of those banks? Because I hear from my developers in our area that no one's lending. So, you got a crack at it?
Sure. So I haven't seen that report, so I can't comment on it, but I can comment on commercial real estate. So we've had a secular change in the economy, which has left office rentals in many places, office buildings. The demand for them is significantly lower, at least temporarily and perhaps for a long time. And also the same is true for downtown, in some places, downtown retail that's associated with office workers. So it's a shock to the system, and we've known this for some time, and we've gone through the commercial banks in the United States and so have the other regulators. We've done it jointly and identified the ones that have high concentration and are going to need to deal with that. And so we've been in contact with those banks and talking to them about how they're going to deal with this. How are they going to absorb these losses? Do they have enough capital? Do they have the liquidity? Do they have a plan to do this? And is it consistent with their lending practices and that kind of thing? So it's going to be something we work through over a period of years. I do think it's slow moving. I think that part of it is right. You ask about 500 banks. I have no idea about that number. But certainly there would be some banks, probably smaller ones, that have these high concentrations. It's not the very large banks. It's really a manageable thing at the large banks. So I think that's what it's going to be, and it's a serious problem, and more serious in some locations and jurisdictions and with some banks than others. But it's one we'll be working through, and I think that's how I would think about it.
Does the Silicon Valley Bank situation, Signature? The money moves so quickly in those cases. It was instantaneous now. The velocity of money moving out of those banks really, I think, in some ways contributed to their failures. Are we looking at anything technologically that might be able to address some of that or mitigate it?
Sure. So we also, after Silicon Valley Bank, we got in contact with and worked with financial institutions that had high concentrations of uninsured deposits. And many of them have greatly improved their liquidity position. So that's the thing that we're working on. Okay. As you probably know, we're also working on some liquidity rules, which will strengthen our framework of liquidity rules. But that's something we haven't proposed yet.
Let me ask you something off topic. So we know that Russia has about $300 billion in U.S. We've frozen assets, Russian assets of about $300 billion between U.S. and European banks. You want to comment on that? What I'd like to see is us give that to Ukraine, to be honest with you. I know that's a very simplistic idea, but I'm just wondering if there's any historic example that we could look to if Congress has to take the necessary steps to redirect that money to Ukraine so they can feed their people and fight that war.
This whole area of sanctions and foreign assets and things like that is really controlled and directed by the administration, by the elected branch of government. All we are is just a technical seat around, in the back row to help. We don't make those decisions, and I wouldn't comment.
I know you're big on history. I was just wondering if there was any examples out there that we might provide guidance to us.
Gentleman's time's expired. The gentleman from Texas, Mr. Williams, now recognized for 5 minutes.
Mr. Chairman, thank you for being here. When I'm back in my district in Texas, I'm constantly hearing concerns surrounding the fundamentally flawed Basel III. We've talked length about that today, endgame proposal. These concerns are not only coming from my banking industry, but also from farmers, ranchers, small business owners who are concerned about how this proposal will impact the ability to access capital in the future. And to all of us, did it not raise alarms? And we've heard about the 97% today of public comments on this proposal, and they all came out negative. And Americans across all sectors are worried about the disastrous implications that will follow this proposal and have tried to make that known to banking regulators who continue to ignore them. It's time for federal regulators to take these concerns seriously and, quite frankly, I believe, start over. So I urge you and your colleagues to rethink the misguided policy and do what is best for American people, small business, Main Street America, and withdraw the Basel III proposal. Now, Chairman Powell, given the concerns raised by financial institutions, again, farmers, ranchers,
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Level. Now, these regional banks will face increased costs when they are already facing towering regulatory burdens from this administration, and those are the banks that people do business with. So, Mr. Chairman, do you believe that this proposal rule goes against the requirements of S2155, the Economic Growth, Regulatory Relief, and Consumer Protection Act, and will you commit to exploring
from the UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Economic report. We've got 3.1% economic growth, by far the best in the developed world. Headline inflation, 2.4%. And that's not a little blip, you know, a 1 month number. That's for the whole of 2023 and compares very favorably with the
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
The economy works best with a 2% inflation rate target. But I've looked at the history of that 2% number. It seems to come from Auckland from the 1980s. And there's a lot of arguments that your target should be just a little bit higher. Larry Summers recently produced a study arguing that the cost of money is part of the cost of living. So we have this weird paradox where you're trying to keep the cost of groceries down by raising interest rates. But as the ranking member points out, the big issue is housing. And your measure of inflation seems to treat all Americans as renters, even though 2/3 are homeowners. And so when interest rates go up, that's an increase in the cost of living for anyone with an adjustable rate mortgage, anybody looking to buy a house, anybody with a home equity loan. Obviously, we would cut interest rates a little sooner and a little more if your target was something closer to 2.3%. So I'll ask you, is there substantial economic analysis that argues that your target rate and the economy would work better if we had a slightly higher target than 2%?
Not really, no. What's happened is, you pointed out in New Zealand, but what's happened is that 2% has become the global standard. And it's a pretty durable standard. I don't have any reason to think that it's a problem for the United States to get to 2% inflation. You know, we're at 2.4% right now, headline inflation.
I would ask leave to add to the transcript of this hearing numerous articles that argue for something between 2.3 and even 3%. I'm not arguing for as high as 3%. Let's look at Basel. There's nothing free here. If the standards are too high, we lose economic growth. If they're too low, we have bailouts and bankruptcies. But I think everybody agrees that the standard should be well crafted. You've got a system where everybody drafting this is well dressed and focused on Wall Street. And you've got Basel rules that discriminate against Main Street and for Wall Street. I'll give you some examples. 65 basis, it's 65% if you're a publicly traded company and make a loan to a publicly traded company. You make a loan to CalPERS, they're not publicly traded, without objection, like to put in their article into the record. And so they're, in effect, going to have a tougher time getting a loan. The local pizzeria is going to have a tougher time getting a loan. You've got in Basel III ignoring mortgage insurance, which obviously makes the loan more prudentially sound for the bank. and is very necessary for first-time home buyers. And you've got a system where if you make investments in long-term bonds on Wall Street and you put them in the hold to maturity category, you don't have to recognize the losses and mark to market. So I hope you'll look at these in terms of the competition between Wayne Street and Wall Street for bank loans. Finally, we go to clean energy investment. Can I count on you to personally look at the paradox where Basel III treats clean energy tax credits much more harshly than low-income housing tax credits for no ascertainable reason?
Yes.
Thank you.
Gentleman's time has expired. The gentleman from Georgia, Mr. Loudermilk, is recognized for 5 minutes.
Well, thank you, Mr. Chairman. Mr. Powell, thank you for being here today. I'm concerned with the small dollar credit for businesses. As a former business owner for over 20 years, I can attest that as the small dollar business credit becomes more expensive and less convenient, businesses are going to turn to credit cards and other alternative financing for business purchases. These inevitably result in even higher costs, which goes down to the consumer, which means that they're going to pay more for the services or the products. But in February of this year, total credit card debt reached a record of $1.7 trillion. According to Intuit's Small Business Index annual report, average monthly credit card balances were 27% higher in 2023 than they were in 2019. What do you view as the driving force behind these record high levels of credit card debt?
Part of it would be growth in the economy, so that'll be part of it. Just that it's a bigger economy and a bigger number. I'm not sure what that is. You know, as you know, people had lots of extra cash during the pandemic from forced savings. They've spent that down. Now they're borrowing. I'm not sure.
So, if there was a rule to force banks to tighten lending, do you think the rule would drive businesses and consumers to alternative forms of credit?
I do. I think, you know, if you raise lending costs for banks, then at the margin that will make non-bank lenders, you know, they'll get some of that business.
And if it becomes more complex or less convenient, then businesses will turn to these alternative forms like credit card. I can tell you that from experience. Yes. Well, I've called for the withdrawal of the Basel III endgame proposal entirely. Will you commit to an analysis of how bank capital proposals like Basel affect small business credit access and the small dollar lending before finalizing such proposals?
I commit to that. Let me look into that. I don't want to make a commitment that I'll undertake some big study, but we'll look at the issue.
But do you feel it's important that we do have an understanding the effect it's going to have on folks? Small businesses, the backbone. It's the bloodline of our economy.
They create the jobs. That's right. I do agree. Yeah.
Okay. The chairman asked you for your thoughts on withdrawing or reproposing the Basel III endgame proposal. Have you specifically discussed withdrawing the proposal with Vice Chairman Michael Barr or the other governors?
So I don't want to get into our internal doings, but I will say that I understand it is a live option. Again, we're not at a stage of being able to even have that discussion yet because we've got to decide first what changes do we think are appropriate, and that'll take a little time. And then the question will be reproposal. What I said is when we get to that point, if reproposal is the right thing to do, we're not going to hesitate at all. It's a perfectly live option.
All right. In the current environment we have in politics in this country, there's not a lot that you find bipartisan agreement on, but I think you could find some agreement in withdrawing that proposal. Can you explain the importance of broad consensus at the Fed on proposals like B3E? Are you concerned with recent trends of disagreement among board members related to major proposals?
So I think we're going to get to broad consensus at the Fed. I do. I think it's very important. You know, this has been our culture that we try to find common ground, and we've been able to do that in the regulatory space, and I expect we will be here as well. And I'm committed to that.
Could it be that we're seeing this level of disagreement because of extreme measures that are being taken now that may not have been taken in the past? I mean, a total difference of opinion and understanding and philosophy regarding a free market economy.
I won't speculate, but I will point out that 4 of the 7 governors during the open board meeting at which we put it out for comment expressed real concerns, very specific concerns about the proposal, and said we would look at the comments when they came in, and that's what we're doing.
All right. Do you feel that they have validity in their concerns?
I was one of the 4, so yes.
All right. With the few seconds I have remaining, there's a recent report of FinCEN working with financial institutions to query legal purchases made by American citizens. Has the Federal Reserve been instructed within the past 3 years by Treasury or anyone else to search Americans' legal transactions?
Not that I know of, no.
Okay, thank you. I yield back.
Senator from Illinois, Mr. Foster is recognized for 5 minutes.
Thank you, Mr. Chair, and thank you for being here.
Listening live to Fed Chairman Jerome Powell as he testifies before the U.S. House Financial Services Committee. Let's go back.
And separate from that, there remains a longer-term need for reconstruction assistance to Ukraine, which the World Bank estimates is somewhere north of $400 billion. Now, at the start of the Russian invasion, the free democracies of the world froze roughly $300 billion in Russian currency assets, primarily at European banks and financial institutions. And the Biden administration and many of our allies have recently taken the stance that those assets should be leveraged somehow to provide reconstruction resources to Ukraine. I support this concept, and I believe that additional action should be taken to ensure that we hold Russia accountable. But there are real concerns on the impact that this might have on central banking system, on the primacy of the dollar, the euro, and so on. And so my question is, have you seen just the act of freezing these assets and not seizing them, but simply freezing them? Have you seen deleterious effects on the primacy of the dollar, the confidence in the central banking system? Is there any visible downside from the act of freezing that's visible so far in the 2 years since we've done
it? I can't point to any. I can't point to any.
Okay, so that's an interesting observation when we think of taking the additional step of actually seizing them, that at least so far, because, to my mind, having them frozen is as violent as and as violent as seizing them outright. And so that's interesting that so far we haven't seen that. Now, in terms of the Basel III and so on, there's a frustration I've had over the fact that directionally the effects of these are clear, but the magnitude of effects are not. For example, if you talk about the effect on the prices seen by derivative end users of increased capital requirement, directionally it's clear. If you raise capital requirements, banks will withdraw from these markets to some extent. Other players will step in partly and take up part of the slack, and the spreads will increase and so on. Is the data that you've collected enough for you to actually estimate the magnitude of these effects instead of simply the direction?
I think it's really hard to get down to the micro level and try to assess that, because you're right, there would be multiple effects. But you do know that you know the direction, you know what the sign is.
That's right, but if you can avoid financial crises with a microscopic increase in prices seen by end users, that's one thing. If it's a very large difference in the price, so that the magnitude matters a lot when you're doing these balancing things. And a lot of it depends on, actually, you need a model for how the different market players will react. And is that really not going to be in the scope of the analysis that you anticipate from the quantitative?
I believe we have done some work on that, and I think the banks and other participants have done work on that as well, and come up with a range of answers. But this is there are just an awful lot of variables in these equations, so it's hard to say with any confidence. That's why it's hard to. The job of deciding the precise level of appropriate capital is a hard one.
Yeah, and now with you know, with 10 years, we've had two major crises with both a fiscal and a monetary response. Are there the lessons that you can learn now that, you know, I believe, and it seems like your testimony indicates that we're kind of approaching back to normal now? And we've seen in the crisis of 15 years ago, we saw what many people thought was an inadequate fiscal response, that the fiscal response was, you know, less than half of the output gap. And we limited by political, you know, political will to do things. And then, of course, you were limited by the zero bound in what you could do for most of a decade. And we had a long recovery. And the comparison, you know, to the COVID recovery has been very sharp, and it's quite remarkably put us right back on that track. Are there any lessons that you've sort of drawn about the importance of the getting the right balance of fiscal and monetary response to these shocks?
So we think about that a lot, and I think I have to start by saying it's too soon to really tell, because the answers you would give today, the picture looks very different than what it looked like a year ago. And so, and a year from now, we'll be looking back going and saying, we've learned so much more. So I think the pandemic is still writing the story of our economy right now. And we should just be prepared to be surprised with the next chapter, as we were with 2023, the very strong growth, the sharp decline in inflation while the labor market remained very strong. Very few forecasters had that, but we can talk about it.
Gentleman's time has expired. We'll now go to the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Thank you, Chairman. Chairman Powell, thank you for being here today and for your testimony. I'd like to start off, first of all, by completely echoing everything Congressman Barr said. A lot of us have talked about Basel III endgame, and I think Congressman Barr kind of nailed the thought process. I do hope you'll withdraw that and take the comments you've heard from here and from so many others about the hazards with the current approach. But I'd also like to address one of the other practices by the Federal Reserve, and it's the practice of paying interest on excess reserve balances held with the Fed accounts. It's my strong belief that rewarding banks with returns for taking no market risk actually harms our economy, and it discourages financial institutions from lending money into the economy. Instead, they park it at the Fed. This has little to no impact on very large corporations, but it can have a crippling impact on small and mid-market firms. And we especially saw this in the long recovery as Dodd-Frank was implemented in the Obama years, transition to the Trump years. We changed some of that mindset with a lot of other policies, but we saw a strong surging economy. So our country would pay a price for this market distortion by the Fed in two ways. First, they're unable to obtain loans at competitive rates because the money's sucked out of the market. Frankly, a lot of them don't even have access to lending except through bank capital. So it forces them into other forms of capital, equity capital, and others. Second, they ultimately pay higher rates whenever they have these alternative means of capital. And so today I've introduced a prohibition on the IOER Act, which would prohibit the Federal Reserve from paying interest on excess reserves. By eliminating IOER, we can begin to return our economy to the undistorted free market economy it's supposed to have. The alternative is you could simply raise requirements, but we see some of those moral hazards when you do it across the board with approach like Basel. So what's your case for why you should keep paying interest on excess reserves?
Well, as you know, we don't see the downsides that you're talking about. You know, banks have a cost of funds and they have what they can earn, and that's what really matters is the spread.
And if they wanted to do it, they could simply buy treasuries on their own, and they could do that independently. I suppose they can independently keep it at the Fed, but they don't have to buy. They don't even have to put it on their own balance sheets in the same way. They've got immediate liquidity with Fed overnight account. So I don't see how that's different than what they could already do.
What I was going to say was, you know, banks can earn a much bigger spread by lending to corporates. So their incentive to lend is the same as it always was. This doesn't affect that. You know, really, it's they have a cost of funds and they have the ability to have reserves, but you know that's not going to. They're not earning a profit on that. So, or a big one. They can earn a much bigger profit by lending to small corporates.
Well, speaking of profit, I mean, the Federal Reserve isn't officially supposed to be a for-profit corporation, but you are supposed to pay for your operating costs off of positive cash flow. And right now, the Fed doesn't have positive cash flow. In fact, the Fed has negative cash flow. So it's not entirely unrelated that the Federal Reserve operated at a $114.3 billion loss in 2023 and currently is carrying a $133 billion loss on its balance sheet this year. So it's, you know, not the right approach, I think, to be paying essentially that much out in excess reserves to banks that are holding capital in the Fed when they could be deploying it into the market. So right now, the interest you're paying banks and money market funds exceeds the income you're getting on the $7.6 trillion balance sheet assets that you have, to the tune of $133 billion asset. So, you know, effectively, the Fed is operating at an operating loss. So what's the path back to cash flow positivity for the Fed?
As you know, for many years during the QE large balance sheet period, we've contributed way over $1 trillion in net earnings to the bank, which to the Treasury Department. So you can't look at the loss without mentioning that we've been giving effectively $100 billion a year in profits every year to the Treasury Department. So the other side of that is when we raise rates to do the job you've assigned us to get inflation under control, when we do that, we absorb paper losses. It has no effect on our operating, the way we operate the Fed. And if we retained all the earnings we have, then it wouldn't be a problem. But we don't do that. We give that money to Treasury.
Thank you. And I think the last thing is I just encourage you to halt any effort to develop a central bank digital currency. It doesn't need designed, developed, and it certainly doesn't need established. I yield.
The gentlewoman from Ohio, Ms. Beatty. Mrs. Beatty is recognized for 5 minutes.
All right, we're listening to Fed Chairman Jerome Powell testifying before the U.S. House Financial Services Committee. Just kind of a little bit of a reset here. The S&P up 0.9%. The Dow Jones Industrials up 0.6%. The NASDAQ up 1.1%. We have some news on New York Community Bank. NYCB halted for volatility again. Stock down 23%. NYCB sinks, they're halted for volatility throughout the morning here. So we'll have to see. NYCB has contacted investment firms into a possible equity sale. That's according to the Wall Street Journal. So again, some news for NYCB, the stock trading lower here. And we'll have further reporting on that right now. Let's head back to Washington, D.C. Fed Chairman Jerome Powell, as he testifies before the U.S. House Financial Services Committee.
Also substantiated by the Federal Reserve of New York and Michigan surveys that I've read. It also talks about job gains and uses the word robust jobs. So I want to thank you for educating us on that. And Mr. Chairman, I'd like the record to show that all of this also resulted during the Biden-Harris administration of making sure. So often we hear in this committee and other committees about what the administration is not doing and what our economy and jobs look like. Now let me move on to something that's very dear to me, and want to thank our ranking member for bringing it up, and that's the lack of affordable housing, which is one of the primary things that I hear about when I'm back home. I'm on more panels to try to explain what you do, what we do, or oftentimes what we don't do and why we have this. While I know that interest rate hikes have successfully brought down the inflation, rising rates have also had an adverse effect on the cost and the pace of housing construction and costs. Are you concerned about the effects that interest rate hikes are having on the cost of financing new construction? And the second part, how do you expect to control for long-term housing inflation that might have a potential rate cuts, how it might affect that?
So our policy to bring inflation down is to raise interest rates, and that works through several channels. One of them is probably the most important, is interest-sensitive spending, and within that you have housing and durable goods and things like that. So, during the early days of the pandemic, the housing industry was about to all go bankrupt. And all of the facilities that we did really supported that industry through their critical time. When we're going in the other direction, when we're raising rates, housing is definitely affected. We understand that. It's not something we want to have happen, just it is the reality that housing will slow a lot when you raise interest rates. We've done that, and we're doing it for the longer run benefit of the people we serve to restore price stability, which is beyond value for people to have price stability. We get it that in the near term, that's higher rates, that's fewer sales, people are locked into low rate mortgages, we get all that, but we got to do this because it'll benefit the country and people in the longer run.
And I have a great appreciation for that. But also when I go back home to the district, what I hear a lot from agencies and individuals who work with advocacy groups, that the effects of interest rate hikes are not borne equally to all American households. So we hear that, and there's no doubt that low income and minority communities are hit the highest or the hardest by these monetary policy changes. Black households and business owners have historically faced challenges with home ownership and access to capital, and they're disproportionately impacted by the rate hikes. Does the Fed, do you have anything that you could help me with this dilemma and how we can better achieve economic goals in a more precise and equitable manner?
So I think it's working. You see inflation coming down, and that's why I do think it's likely at some time this year, if the economy, proceeds along the path we expect, that we will begin to reduce rates. So that's really the path that we're on, and I do hope it works out that way.
And when you say, I don't have a lot of time, but when you say economy, what does that mean? Helping poor people and black people get more jobs, more money?
So our forecast is for continued strong growth, continued strong labor market with wages going up and also with inflation coming down. So that kind of an economy.
Okay, my time is up. I yield back. Thank you.
The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chairman McHenry and Ranking Member Waters, for holding this hearing, and thank you, Chair Powell, for being with us today. I'd like to start by discussing the independent automated teller machine owners or operators section of the Bank Secrecy Act examination manual. I want to ensure that financial institutions will not be discouraged from providing banking services to the independently owned ATM industry. In 2021, you made it clear that the industry does not automatically present a higher risk for illicit finance. I'd like to know what efforts have been made by the Federal Reserve to fully communicate that position to financial institutions across the country.
I will have to get back to you on that one.
All right, thank you. Well, and so I might just add, listening to independent ATM operators over the time that I've served in Congress, I've come to understand that unfortunately, and it was in the Bank Examiner's Manual up until just about a couple years ago, these operators were identified as being extraordinarily risky, and that was causing them to be debanked in many cases. So I do hope that you'll take a look at that and make sure that we're communicating that to financial institutions and, most importantly, to the regulators. Chair Powell, Tennessee is home to over 1,000 foreign-based businesses that have chosen to invest in our state and create more than 160,000 jobs. These jobs are reliant upon cross-border financing provided by global banks, including foreign banking organizations. The Federal Reserve has long maintained the principles of national treatment and equality of competitive opportunity when regulating foreign banks and assessing them based on their U.S. operations. Are you still committed to these principles?
Yes.
And how will these principles be reflected as you move to finalize the Basel Endgame proposal?
So we have received a whole separate set of comments from the foreign banks, and we'll look at those, very much in that spirit and make appropriate changes.
Thank you. Chair Powell, the Basel III Endgame will incentivize firms to transfer credit risks off their balance sheets. One avenue for such a transfer is synthetic securitization, the framework of which must be approved by the Federal Reserve. However, it is my understanding that there is a substantial backlog of reviews and approvals of these securitization frameworks. It is concerning that the Federal Reserve is directed to is directing the risk transfer, yet also impeding it, in my view. Can you comment or can you commit to reviewing this approval process and taking steps to reduce the backlog of pending securitization applications?
So as I understand it, these transactions are becoming popular right now. There's a lot of appetite to do them, and we're not stopping them. We're just being careful because there were similar things that happened about credit risk transfer during the global financial crisis that didn't actually work out. So we want to make sure that these structures really do actually durably transfer, and we think that they do, but we just need to be careful because the last experience with these was difficult back in the last crisis. So it's just something that we're not intending to slow these down, and I think we'll try to get through it.
Is it a lack of available resources to apply to the approval process, or is it an intentional slow walking to make sure that every I is dotted, every T crossed?
I don't actually know, but I do. What I heard was what I've been told is we're not stopping these, but we're going to be careful with them and just be absolutely careful that they really do transfer credit risk in a durable, kind of sustained way. And that's the thing. And I don't think it's an intention to go slow or to have a backlog. It's just, and so I don't know what the staffing issue is. We'll check.
All right, thank you. As the Federal Reserve continues to consider proposals designed and debated in Europe, such as Basel III, has the Federal Reserve's Supervisory Climate Committee or the Financial Stability Committee had any discussions regarding the adoption of ESG risks in capital requirements?
I don't know.
Has there been any discussion in other committees regarding the adoption of ESG risks in capital requirements?
Any discussion? I really don't know. Let me say that's not something we're considering, but when you ask me any discussion, I don't know.
It's not a priority in capital requirements.
To put it mildly, yeah.
Okay. Thank you. I see my time is running out. I appreciate your answers, and any further light you can shed on those matters, I'd appreciate. I yield back, Mr. Chairman.
The gentleman from Illinois, Mr. Caston, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Chairman, for being here today. I want to start just with following up on the exchange you had with Mr. Sherman. As I think you know, I led a letter with 106 of my colleagues with concerns about specifically the clean energy tax equity provisions in Basel. I appreciate your commitment to look at that. I wonder if I could just put a little bit of a sharper point on it. Can you look at that before the rule is finalized and potentially issue some sort of an addendum to the rule? The concern I have is the number of banks who are a little bit frozen right now, waiting for some clarity on that, and I'd prefer we not slow down the rate of clean energy investing in our country if we don't have to.
I don't know. I mean, I think there's a proposal, and we're well aware of the commentary, and we're going to react appropriately. I don't know that we can pull one thing out of line and deal with it. But we're making good progress, and I think we'll be back reasonably soon with some answers.
Okay, well, time is of the essence. Appreciate anything you can do. Second thing, good thing about going late here, you get to follow up. I want to follow up on your discussion with Congresswoman Garcia here. I really appreciated your comments in the 60 Minutes interview last month when you mentioned that immigration is a big part of the story of the labor market coming back into balance. Now, generally, and correct me if I'm wrong, more immigration is generally going to ease inflationary pressure. Is that all else equal? Is that a safe characterization?
It's probably closer to neutral, actually, because people come in, they also spend, so it's not clear that immigrants coming in, they add to GDP.
Okay, so either we're going to get economic growth and or downward pressure on wages.
More workers, so that wages might go up a little bit less, but at the same time they're also spending. So we had this conversation. It depends on what you assume, but I think it's better to just assume it's sort of broadly neutral from an inflation standpoint.
So I guess, and maybe you've answered the second question, but given as you all are using the Census Bureau data that is more conservative than the CBO data, and obviously we're all making estimates in the future, can you speak at all to whether your forward views on economic growth and inflation, how sensitive are they to your assumptions about that census versus CBO data on what the actual level of immigration is to the country right now?
I think the CBO assumptions are meaningfully higher and would affect growth and would be part of the explanation why growth was strong last year and would be a reason to expect. I mean, it's not the main reason, but it would definitely add to growth this year. And I wouldn't say that we accept one version or the other. We're studying, we study the CBO numbers carefully. We're just trying to get to the right answer. And, but I mean, I think the CBO shows, and they say so, stronger growth, higher growth, more people. I don't know the per capita growth goes up, but the absolute level of growth goes up.
Okay. Last question. I think there's a lot of good news in the monetary report that you all just issued around wage growth. We've seen, the lower quartile of earners starting to close some of those historic gaps. We've seen minority groups and women start to close some of those gaps. What I didn't see, and I don't know if this is because you all haven't done it or I just didn't read closely enough, have you seen any gaps regionally within the U.S.? Are there parts of the country that are seeing stronger wage growth than others?
There are. I don't have that off the top of my head. I want to go back and if I can just, when I talked about immigration, I think that the immigration story for last year was part of the positive supply shock and was part of the reason why inflation came down. I was really asking the question over the longer run.
Fair enough.
And there, I think it's more of being neutral.
I appreciate that. I want to just close on this regional piece because the Atlanta Fed, which is the best I could find that looks to do at least some by census regions, that as I look through, there's and you look at which regions are consistently running above. I think that New England and the West are consistently showing wage increase above average. And the West, South, Central, Texas, Oklahoma, Arkansas, Louisiana are consistently, I think going back to like July of 2022, consistently seeing wage growth below average. And I appreciate you're not going to wade into a political question here, but those are all right to work states where it's harder to unionize, where it's harder to organize. And what I'm wondering is, without asking you to opine on policy, have you all at the Fed done any analysis that says, as we look at when there are gains in labor productivity, does that gain in labor productivity, is it more likely to accrue to workers in those states where there's a stronger union presence, easier to organize, and more bargaining power for labor as opposed to capital?
My guess is there's plenty of research around that area, not necessarily at the Fed, but we'll take a look and come back to you.
Okay. All right. Thank you. I yield back.
Gentleman's time's expired. Now go to the gentleman from South Carolina, Mr. Timmons, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here today. We continue to appreciate your work and the work of the Federal Reserve on behalf of the American people. In August of 2023, the Federal Reserve, FDIC, and OCC released the NPR requiring the issuance of long-term debt for Category 2, 3, and 4 banks. As you may know, I, along with many of my colleagues, authored a letter to each agency expressing concerns regarding the lack of tailoring in the proposal and shortcomings in estimating the actual cost of the proposed rules. I'm concerned that these shortfalls will negatively impact lending in my district, and when combined with the other ongoing regulatory proposals, could cause further consolidation of the banking industry. It appears that the Federal Reserve has primarily deferred to the FDIC concerning the proposal. Could you shed light on the Federal Reserve's role within the rulemaking process concerning the long-term debt proposal? And have you provided input regarding the proposal's interplay with Basel III Endgame?
I think we're one of the proposers of the rule, just like the other agencies are. And right now we're looking at the comments that we've gotten. That comment period, I believe, has closed. Yeah, and so we're very much in reading those comments as the law.
You're in the middle of it. Fair to say.
are.
Okay, thank you. I'm concerned that the long-term debt proposal's lack of tailoring contradicts the statutory requirements of the Economic Growth, Regulatory Relief, and Consumer Protection Act. Instead of applying tailoring principles, this proposal creates Category 2, 3, and 4 financial institutions identically for the purposes of long-term debt issuances. Additionally, the proposal unduly burdens Category 2, 3, and 4 banks by requiring them to issue long-term debt at both the parent holding company and bank level, which actually could be viewed as reverse tailoring, considering GSIBs are only required to issue debt at the parent company level. What is the underlying rationale behind this dual requirement, particularly when such a mandate is not imposed on our largest banks? And do you believe that this represents a tailored approach as required by the statute?
So that tailoring question is one of the questions we'll be asking ourselves as part of our review of the comments.
Thank you. It's my understanding that Category 4 banks were not included in the original advance notice of proposed rulemaking for the long-term debt rule released in the fall of 2022. Is that your understanding as well?
I didn't catch that.
Did the advance notice that was released in the fall of 22 include Category 4 banks? It's my understanding that it did not.
I can't confirm that, to be honest.
Well, I think that's something that you should take into account because the Category 2 and 3 banks have had an additional year to foresee this challenge. And so Category 4 banks are really behind the 8 ball. And yeah, so I guess my next question is, do you believe regulatory agencies should provide smaller regional banks longer than the 3-year phase-in period to meet any final long-term debt requirements?
It's a good question. That's one of the comments we've gotten, and we'll be looking at that.
I appreciate it. I just think if we're going to impose these new regulations, giving everyone the same opportunity to comply with them is something worth considering. I guess one final question. If these proposed regulatory changes had been in effect prior to the fall of SVB and Signature, do you believe the outcome would have been different? Because honestly, I don't think anything would have changed.
You know, it's a hypothetical. I'm tempted to say that if there had been more long-term debt there that was specifically there to absorb losses.
They were nowhere near being solvent, but I guess that's something I think y'all should take into account, whether if these proposed changes to our system that are designed to make it more resilient would have actually caused SVB and Signature to have a different outcome. Because again, it just seems that my colleagues across the aisle let no crisis go to waste, and these are changes that would not have in fact prevented the calamity that they are justifying the changes based on. Thank you for being here today, and with that, Mr. Chairman, I yield back.
Thanks. Gentleman yields back. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you. Due to the Fed's aggressive interest rate hikes, mortgage rates have surpassed 7%, rising to 20-year highs, leaving many credit-worthy and mortgage-ready homebuyers without a path to home ownership. This is a problem for everyone. It's an urban issue, it's a suburban issue, it's a rural issue. Chairman Powell, I welcome the decision of the Fed to pause rates at the end of last year. But for families in my district and across the country, that is not enough. We need the Fed to start cutting because, like the rent, interest rates are too damn high. Chairman Powell, you've previously indicated that the Fed may cut rates this year. What would you expect the impact of lowering interest rates to be on the housing market specifically, including the rental, purchase, and construction market?
So we know that higher rates, of course, have slowed down the rate of activity. So if at such time as we start to lower interest rates, housing market will pick up broadly across new home construction and new home sales. The number, as you know, many households are in very low rate mortgages, and they really can't sell because they'd have to refinance into a high rate mortgage. That'll go away over time. So ideally, the housing market would go back into a more normal phase, but one with lower inflation in the broader economy.
Right, so just to further reiterate that, interest rate cuts would have a great benefit. Just yesterday, actually, I met with a number of representatives from state housing finance agencies from throughout the country, and they were talking about the barriers to affordable housing projects given the current interest rate environment. Obviously, higher interest rates have raised costs for affordable housing developers, and many of them have chosen to slow down or halt construction entirely. So fewer homes are being built, which means fewer people are being housed. So given that would you agree? So given that we already had a massive shortage of affordable housing supply prior to the pandemic, when interest rates were below 2%, the current rate, 5.5% rate, has been devastating. And the price of homes across the country have remained stubbornly high. It's clear that the current state of our housing market is impacting everyone and disproportionately hurting those who need stability the most. Does this concern you?
So our job is to do price stability and maximum employment. We don't target the housing market, and we're doing our jobs. That's what we're doing. It's not something we want to see, but
does this
impact
impact on the housing market? But does it concern you, Chairman Powell?
Does it concern me?
Yes. Fewer homes are being built, so fewer people are being housed.
This is the job we've taken on.
All right. Well, it concerns me greatly. Chairman Powell, the Fed's interest rate hikes have not been sufficient in addressing housing inflation. Do you agree that we need a more robust fiscal response to increase the supply of affordable housing and to lower costs nationwide?
So we don't take opinions, we don't express opinions on things like that. I will say that there is a structural housing shortage in the United States, and that's really the longer run problem. The problem with high interest rates is a short run problem. The longer run problem is lack of supply.
Well, that's why it is critical that Congress pass legislation and appropriation bills that will make those necessary investments in housing for all. You know, given the way that Ranking Member Waters fought for $150 billion investment in housing and Build Back Better, I know on this side of the aisle that my colleagues and I are ready and waiting for the Republican majority to take housing inflation seriously. Housing affordability is the #1 issue I'm hearing about from my constituents. Families in my district and throughout this country need relief now. I truly hope the Fed will listen to them and cut interest rates. Thank you. I yield.
Gentlelady yields back. The gentleman from South Carolina, Mr. Norm, is recognized for 5 minutes.
Thank you, Chairman Powell. I think other people have noted about the crisis in the office building market across this country. That's a line of work we're in. I can tell you it's real. I can tell you the buildings that are effectively vacant, it's going to have an effect on the taxes paid. It's going to have an effect on rents. As far as affordability in housing, you know, the rates are one thing, but my good friends on the other side of the aisle don't realize that housing has got over 200 components to it. One of the biggest is gas prices. And as long as we're buying gas from countries that hate America and don't manufacture our own, housing isn't coming down. I don't know how you define affordable anyway. It's going to continue a downward slide. And I'm from a state in South Carolina that people are moving in, and we're not going to have the housing starts that we should have because of the policies of the Biden administration, which is train wrecking this entire economy. On regulations, on Regulation 2, which is has the guardrails for credit card fees, how do you answer and I know the caps you're looking at adjusting that. How do you answer the charge that this is really should not be, you're getting in the way of banks charging fees according to what their costs are? How does the regulations affect that, particular Regulation 2?
Is this a Fed regulation we're talking about,
Yes,
or is this the CFPB regulation?
No, this is, for my record, it's the Federal Reserve has finalized the routing and restrictions and proposed tighter and adjusting the price caps that currently exist. Is that not right?
It doesn't ring a bell with me. It may well be right. I'm not familiar.
If you could look at that, I know all the credit unions and banks have got some concerns on that.
I will come back to you on that.
Okay, I appreciate it. Do you need a letter from us? Or
No, we'll come back to you.
Okay, thank you. CRA, for those of us who have been involved with banking for a long time, the regulations having a clear set of standards that we abide by and know where to put the money to. When should we have regulations out that we can read about what's going to be acceptable and what's not?
I'm sorry, I didn't get your question.
The regulations on the changes in regulations for CRA.
Right. What about it? I'm sorry, I missed your question.
When are the regulations going to be out that we'll know, the banks will know what's acceptable for CRA and what's not acceptable?
So the final rule, of course, is out. I think we're working on, there's a lot of work to do. The requirements don't really kick in, most of them for a couple of years at least. So I think we're working on the follow-up regulations.
Okay, that's really important for all the banks because they want to make sure they qualify, and where the dollars are spent, they need to make sure that it's going into the right spot because the credits won't be applied unless that's it. The Fed now, where the Federal, I think, Reserve launched and is operating this now, how is the participation rate going with that?
Slow, real slow. It's early days. There are network effects. These things they go slow until they don't. And it was the same way with ACH. You may remember back in the day.
Right.
So we're at fewer than 500 banks are in there now. We're working away at it. We expect it'll take some time, but but it's there, and we think it'll be beneficial. We had a lot of support from smaller banks to build it, as you know.
Is the pricing below cost?
I don't believe so, no, not longer run cost.
Okay. Okay, that's all the questions I have. Thank you for being here.
Gentleman yields back. The gentleman from Nevada, Mr. Horsford, is now recognized for 5 minutes.
I want to thank the chairman and the ranking member for this hearing, and to you, Chair Powell, for appearing before the committee to discuss the recently published monetary policy report. As we continue our work on behalf of the American people, we have to keep in mind that our mission here is to grow the economy from the bottom up and the middle out. It seems as if there has been a constant series of shocks to the economy, both domestically and globally, and yet we can all see just how resilient the labor market has been as it has maintained its strength. With a robust gain of 353,000 jobs, the January numbers are a continuation of the trend that Democrats in Congress delivered through historic investments in our workforce, putting people over politics. In light of this relative economic strength, I really want to implore the Federal Reserve to take stock of the holistic economic picture before making decisions on monetary policy, and to pay particular attention to those communities that have been historically left behind during times of accelerated recovery. I want to add to the questions from my colleague, Congresswoman Presley, Chair Powell. At a time where it has become increasingly difficult for working people and people of color in particular to purchase a home, I worry that rising mortgage rates will put working families even further behind on accessing the wealth and equity that a home provides. So what actions, if any, is the Federal Reserve considering to better understand and to mitigate the impacts that your Basel III proposal may have on minority borrowers who disproportionately rely on high LTV mortgages due to the generational wealth gap that persists?
We've received comments, including many, on the mortgage changes, and we understand the concerns, and we're looking very carefully at that. Haven't made any decisions, but we will announce them when we have.
Are you concerned that these shifts in risk weights will reinforce the decade-long retreat of banks from the mortgage market and push more originations to non-bank institutions?
That's a question that people are raising, and it's something we take very seriously, and we'll be taking that into consideration as we decide about that change, that recommended change.
Could you discuss why you feel it is necessary to include new requirements around operational risk in Basel III in light of recent claims that it will significantly increase the cost of or prevent banks from offering altogether necessary services such as underwriting, investment advisory, or insurance?
That is one of the concerns that's been articulated about the proposed changes to operating risk. We take those concerns seriously. As I mentioned, we're in the middle of looking at these things, and then we'll soon, in the process of turning to the question of what changes to make.
Well, I just would underscore the sense of urgency, because the longer there's uncertainty in the market, it creates really negative effects to end users, which are all of our constituents who are looking to see these costs come down. Let me shift. This Congress, under the leadership of Ranking Member Waters and former CBC Chair Joyce Beatty, I've made it a focus of my efforts to educate my colleagues and the public at large on the far-reaching benefits of increased diversity in the workplace, in our boardrooms, and in society as a whole. Despite the efforts by some on the other side to take away the very tools of economic opportunity that create inclusive work environments and improve performance, there has been a really misguided assault on everything from diversity, equity, and inclusion to other programs following the aftermath of the Supreme Court's ruling on affirmative action. So Chairman Powell, as you know, your Office of Minority and Women Inclusion has a focus on this. So as we anticipate the upcoming release of your annual report on inclusion, would you be able to speak to the necessity of collecting this data that minority and women-owned businesses are included in the board's contracting and acquisition opportunities?
I do believe we collect that data, and we monitor that very carefully.
And why is it important?
Well, I think I think diversity in the workplace is an important thing, and you won't know how you're doing unless you measure it.
And just as the McKinsey Institute released in their Diversity Matters Even More report, companies that have more diverse management teams actually outperform companies that don't. That goes to the bottom line of our economy, and I wish my colleagues on the other side would stop their assault on diversity, equity, and inclusion and actually work with us to grow the economy.
Gentleman's time
for
has
everyone.
expired. The gentleman from Wisconsin, Mr. Stiles, now recognized for 5 minutes.
Thank you very much, Mr. Chair. Thank you for being here, Chairman Powell. Appreciate it. You're navigating a difficult situation where we've had stimulative economic policies from the Biden administration, in particular, excessive government spending, investment in infrastructure, specific tax credits. At the same time, we're seeing a regulatory environment from the administration that's also restricting economic growth. We've heard a lot about the Basel III endgame, which you have a chair of. In your opening remarks, you noted that high interest rates are impacting business investment in a negative way. High interest rates are also negatively impacting the housing market. As we look at Basel III endgame, I've heard from a wide array of stakeholders, from those that are commenting on increase in bank capital standards, the negative impact that would have on the housing market, as well as from the business community, the impact that would have on their ability to invest in capital infrastructure and increase employment. Does the broad diversity of voices who hold concerns on the Basel III endgame concern you?
I would say that I've articulated concerns, and we're reading those comments, and we're very much in the process of assessing what we need to do to address them.
Thank you. I appreciate your time on that. Shifting gears slightly, as you may know, the Securities and Exchange Commission held an open meeting today to approve the final climate change rule. It's a significant regulation that I think would have a significant impact on the economy. Can you comment how the Fed thinks about the economic impact of this new regulation, or regulations more broadly, and in particular their impact on both inflation and on employment?
We don't comment on regulations of other agencies, sorry.
And you'll review that if it's put in place, or you'll review the economic impact as the empirical data comes forward?
We're not in the business of scoring, CBO does that. They'll look at this and make a careful assessment of the economic impacts and budgetary impacts and that kind of thing.
Thank you. I'll shift gears again. One of your two mandates is to maximize employment in addition to maintaining price stability. And as you know, government hiring has accounted for a large share of total job creation. More than 600,000 public sector jobs were created last year, and the federal government now employs nearly 3 million workers. So when you're examining employment data, how does the Fed view the impact of the public sector employment growth relative to private sector economic growth? In other words, how do the two data points factor into your assessment of how the broader economy is performing?
So the jobs are jobs, right? But I think we would tend to look at private sector jobs to get a better assessment. Private sector job creation is a better indicator of kind of the private sector momentum in the economy. But we look at both. They both count.
And does the dramatic increase in the private sector number of jobs give you any pause or concern as it relates to—
You mean in the public sector?
In the public sector, sorry if I misspoke, yes, the public sector.
The truth is the public sector was unable to hire at the beginning because wages went up a lot in the private sector at the beginning of the pandemic inflation, and public sector can't respond to that. So there's some catch-up hiring going on there now. Now that things are settling down to normal, I think there's some catch-up hiring. I'm not sure it's an issue we're concerned about.
Okay, I'll shift gears in my final minute just to talk a little bit, to get your perspective on the macroeconomic developments that are having an impact on our monetary policy, specifically as we think about the potential for a productivity boom, from AI to work at home to other factors. The data is probably too early to tell whether or not we're having a true productivity view, but how does the Fed view the adoption of some of these new technologies, in particular AI, as it relates to labor productivity?
So everyone's looking at AI for that question, and it's hard to say, actually. We've had really nice productivity in the last year or so, but it's probably still very much affected by the post-pandemic factors that we're seeing. I think we need to see more to understand whether there is a longer-term boom. AI certainly has the capacity to either augment labor or to replace labor, and that's a key question. We really don't know which of the two it will do. Tons of money being invested in it, and so it's likely to drive significant productivity. I would say right now, technology, but also higher labor mobility. A lot of people quitting during the really tight labor market, and also the rise in startups. There were a lot of people started companies during the pandemic. Those are the kind of things that do add up to higher productivity over time. So there is hope that we'll see some productivity out of this.
Thanks for your comments today, Mr. Chair. I yield back.
Gentleman yields back. We'll go to the last questioner of the day, the gentleman from New York, Mr. Torres, for 5 minutes.
Thank you, Mr. Chair. Mr. Chair, I have several questions about some of the most common complaints that I've heard about Basel III Endgame. I have an open mind on the subject, but I want to hear your response to some of the arguments that have been leveled against it. First, the Fed has repeatedly reassured the public that the banking system is well capitalized. Yet the Fed is advancing Basel III on the assumption that the banking system is undercapitalized. So the first question is, how do you reconcile the Fed's repeat assurances about a well-capitalized banking system with Basel III's assumption of an undercapitalized banking system? The second question, if the purpose of Basel III is to align U.S. banks with their banking peers elsewhere in the world, why is the Fed imposing requirements that are more stringent than those prescribed by Basel III? In other words, why is the Fed, quote unquote, gold plating? The third question is, how do you reconcile Basel III's recommendation for standardization with Congress's statutory requirement for tailoring? Standardization would seem to be in conflict or in tension with regulatory tailoring. And the fourth and final question, do you think that Basel III could have the unintended consequence of reinforcing the trend toward shadow banking, which would mean less regulation, not more? Is there a sense in which we are transferring risk from the regulated sector of the financial system to the deregulated sector? So I bombarded you with 4 questions, and I'll give you the time you need to answer them.
I'm going to have a hard time reading my handwriting here, but I'll start with yes to the fourth one. I'll give you that one because that is clearly a risk. We've seen intermediation activity moving out of the regulated system, and this has the risk of doing more of that. So what was, in a word or two, what was the one again?
Just you said, and you testified,
capital, yeah.
repeat reassurances about the capitalization of the bank.
So I addressed this in my remarks in the open board meeting. Higher capital is always going to add to safety and soundness, but there's a cost. Right. And so identifying the precise right level is very, very difficult and hard to do it objectively. I've said for years in these rooms that I thought that the level of capital in the U.S. banking system was about right. So I opposed, and I voted for all these increases during Dodd-Frank. So I think it's a very fair question. We'll be looking at that. The second one was
the concern about gold plating.
About
gold plating?
Oh, gold plating. Yeah, no, it is, and I said this in my public remarks that we're exceeding the minimums with this proposal, and we also exceeded what the other big jurisdictions are doing. And so that's a question. That's a good question. I'll agree.
Okay, great.
And the third?
And the third is, I think you more or less, and standardization versus tailoring.
Standardization of, it was something.
Yeah, so Congress passed a statute requiring regulatory tailoring.
No, that's an
and do you think
question.
Basel III is in compliance with that statute?
I addressed that in my comments too. I think you're right. We do need to take on board the lessons of Silicon Valley Bank as it relates to the smaller, large banks, but we don't need to throw away the tailoring that's required by the law, but also that is appropriate if we're going to have a diverse banking system.
The collapse of SVB was largely a story about liquidity risk and interest rate risk, yet the focal points of Basel III are credit risk, market rate risk, and operational risk. What is your response to the criticism that the Fed should focus its energies on addressing the forms of risk that were responsible for the SVB bank failure rather than focusing on forms of risk that were largely unrelated to it?
So I agree with that, but I would say we are working on a package of liquidity measures which directly addresses the Silicon Valley Bank situation. We've also taken a lot of supervisory actions with other medium and small sized banks that had a lot of uninsured deposits and a lot of real estate risk and things like that. So we've been doing quite a lot on the supervisory section that it doesn't require new rules.
And then finally, as you know, the crippling cost of housing accounts for a third of inflation. One of the most powerful tools for producing and preserving affordable housing is the low-income housing tax credit, which has financed nearly 4 million units of affordable housing. The banking system accounts for 85% of LIHTC investments, and there's a concern that Basel III in its present form would diminish the availability of LIHTC and the amount of affordable housing development. And so I'm just curious, is that on your radar, and is that something you're willing to examine?
Yes, it is.
So with that, I'll leave it at that. Thank you.
Gentleman yields back. That's the final questioning of the day. We committed to the chair that would be done with a hard stop by 1 p.m. It's nice when we can honor our commitments. So I'd like to thank Chair Powell for his testimony today. Without objection, all members will have 5 legislative days in which to submit additional written questions for the witness to the chair. The questions will be forwarded to the witness for his response. I ask you, Chair Powell, please respond as promptly as you possibly can. And with that, this hearing is adjourned.
All right, everybody. That, of course, is Fed Chair Jay Powell finishing up the first of 2 days of his semi-annual monetary policy testimony up on Capitol Hill. A very good afternoon, everybody. Welcome to an extended version of Bloomberg Business Week live on radio, TV, YouTube, and Bloomberg Originals on this Fed Wednesday. A lot going on. I'm Carol Master along with Tim Stenovic, and welcome, everyone, because Wall Street, I think it's safe to say, Tim, breathing a bit of a sigh of relief, if you will, because it feels like we pretty much got the same message, a very similar one from Jay Powell that we got from the last FOMC meeting.
Yeah, I think that's true. A strong economy is going to keep officials on hold for now, though he does expect the Federal Reserve to cut rates this year. Meantime, Carol, as this was all happening, we were watching shares of New York Community Bank Corp because they were tumbling on a Wall Street Journal report that the bank is trying to raise equity capital. At one point, was down as much as 47%. Shares now halted, pending news.
All right, so that's all front and center on this Wednesday. We're also waiting in just a couple of minutes the beige book from the Federal Reserve, from those regional Fed banks. In the meantime, let's get an update on the trade. Let's head on over to Charlie Pellet with a check on that and your top business stories. Hey, Charlie.
Hi, thank you very much. Indeed, lots of moving parts to this market. We've got you covered right to the numbers now, with stocks in the green, very close to session highs right now on the S&P 500 index, up 41 at 5120. We're looking at a gain right now of 0.8%. Dow Industrials up 174 now, higher by 0.5%. The Nasdaq Composite Index up 157, a gain right now of 1%. 10-year yielding 4.09%, with a 2-year right now at 4.53%. Spot gold higher by 0.8%, 21,044 on gold. West Texas Intermediate Crude WTI now with an 80 handle. WTI up 2.4% right now. And Bitcoin, 67,245, up by 6.2%. New York Community Bank Corp trying to raise equity capital to help restore confidence in the beleaguered company. That, according to the Wall Street Journal, citing sources. A trading halt on NYCB, down last trade by 42.4%. And finally, Deutsche Bank has cut the bonus pool at its investment banking division by more than 10% after a slump in deals and a slowdown in trading last year. Again, recapping, Powell speaks, stocks higher, S&P right now up 41. That is a gain of 0.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie Pellet, thank you so much. Carol Master along with Tim Stenovic live here in our Bloomberg studio at Bloomberg headquarters. Obviously, the main event is what we just heard from Fed Chair Jay Powell up on Capitol Hill. Charlie breaking down some of those key points. The Fed Chair reiterated to lawmakers at the U.S. Central Bank, no rush to cut interest rates. Feel like, Tim, we got a little bit of everything. And the Fed Chair really pointing out the importance of not going too soon and also not going too late in terms of making moves to cut rates.
Yeah, here's what he said. We believe that our policy rate is likely at its peak for this tightening cycle. He repeated language used at his last press conference just at the end of January. He also repeated his claim from the January press conference that rate cuts are likely to be appropriate at some point this year. And, you know, I think the market's reacting accordingly.
All right, so let's get to it with more on Chair Powell's comments and U.S. financial market reaction. Delighted to have with us Bloomberg News international economics and policy correspondent Michael McKee. He's there in our D.C. bureau. He's been listening all morning. So, too, has Bloomberg News markets reporter Abigail Doolittle. She's here in our studio. And, Mike, I want to start with you. It does feel like we understood the message at the last FOMC meeting, and I feel like we got a lot of that as well. But what for you, was there anything that was new, nuanced, a little bit different from the FOMC meeting? What is it that was so important in terms of what we got from the Fed chair today?
I appreciate your asking, Carol, but
But
Engaging you. I mean, this was the functional equivalent of Wall Street hoping for a new suit and getting hand-me-downs. It was the same old from the Fed chair. He really can't say anything else at this point. It was more explanatory than anything else, and it's a story that traders have heard now for some weeks from Chair Powell and many other members of the Open Market Committee. But what did stand out today, and what was maybe a little bit of a surprise, was how much bipartisan anger there was at the Basel III endgame bank regulations that the Fed is looking at right now. These grow out of an international effort to raise capital levels and regulation standards in banks around the world. The U.S. hasn't implemented it yet. They've put together a process for putting it in place, and they put it out for comment, and they've gotten a lot of negative comment from the banking industry, who have also sent comments, apparently, to their local representatives. We knew Republicans didn't like it, but today we really got an earful from some Democratic representatives as well. They think it's going to result in less lending to the banks, from the banks in their districts. Their banks will be less profitable. In other words, the message from the representatives is this is bad for business, so it's bad for the economy. Jay Powell was receptive. He was one of 4 Fed members who originally said they had problems with the issue. He made that clear. He said that they are looking at it. They're still digesting all the comments. But as he said, what we could see is broad and deep changes in the regulations before they come out. And he went so far as to say that it is possible they would withdraw the proposal altogether. So the congressmen were heard today, at least on that issue.
Well, thank you very much, Mike, because you kind of opened the door to where we need to go with Abigail, because, yep, we want to talk about markets generally, but most importantly, what's going on with New York Community Bancorp, if we may, Abigail, because as the Fed chair, Jay Powell, was getting lots of detailed questions, as Mike said, on banking regulation, how to prevent another crisis, developing news on New York Community Bancorp, which is halted as we speak, but it was down as much as 47% before that halt.
Yeah, it's pretty incredible here. This beleaguered regional bank, the news just can't get worse. It just keeps getting worse and worse, it seems. And to your point, they are saying that they're trying to raise equity capital. That's been the big question with all the headlines that have come out recently in terms of they're talking about the poor oversight of loans. And then we had a couple of downgrades. One of the downgrades was key because it was a downgrade of basically a certain portion of their business to junk. And they suggested that if that happened, that they could see outflows. One thing they have not updated investors on through all of this are their deposits. So in February, deposits and liquidity was very helpful or healthy, but to not make that update through all of this, you could take it one way or the other, that it's either really bad, they don't want to share that, or they want to pull a rabbit out of the hat. So it's going to be interesting to see what comes on the other side of this.
Hey, Abigail, I want to broaden this out a little bit and just talk about the equity market reaction in general to what we heard from Jay Powell earlier. We do see stocks higher by 0.8%. The NASDAQ composite up by 1%, the Dow up by 0.5 percentage point. Any surprising moves from you after yesterday's sell-off, given what we heard from Powell?
Not really. I mean, the biggest surprise is actually Apple. It's down ever so slightly. I mean, it's not down a lot, but you would think that we'd start to have a snapback for that stock at some point, and some of the momentum indicators suggested that, given the fact that it is down about 14% from its peak, you would think that it would also be participating in this rally. But this rally is a nice snapback from yesterday's sell-off. To your point, the S&P 500 up about 0.9%. Chips doing really well, up 3.2%. So a big rally there. I think very interesting to take a look at is bonds. We have yields down just a little bit. So this tells you, I mean, my take on this, on Fed Chair Powell's testimony so far, to Mike's point, nothing new here. But I think that there was probably a little bit of fear was, would Powell suggest that there would be no cuts this year? Now, if that had happened, I think we would have seen, yields spike sharply higher and stocks tumble. The fact that the worst case scenario didn't happen, we seem to have this relief rally. Does it mean it's going to continue? Not really, because yesterday put a little bit of near-term technical damage for stocks, but investors feel a little bit more sure of themselves today.
You know, our New York team also reporting that Treasury yields hit a new session low after that initial Wall Street Journal report about New York Community Bank Corp looking to raise equity capital. We've also reported this story out, and I was looking at kind of the KRE regional bank ETF. It's down about 2%, and it looked like it took a dip as well on concerns. And I do wonder, you know, when we think about the broader market, we always, Abigail, talk with you about the importance of the mega cap tech names in terms of momentum, whether it's Apple or some of the others, and you laid out some of the move to the upside that we've seen. How important is it to what we see in the financial sector broadly, in the regional bank sector, to the overall market trade?
Well, you know, it's interesting to see the sympathy that we do see in the KRE. So the biggest decliner, not surprisingly, was NYCB before it was halted. I'm looking right now, only 3 members are up out of 140. So you have 137 banks down. But what's so interesting is, as I've dug into the commercial real, and it is trading again now,
NYCB.
Yeah, it's not. Sorry, I was looking at KRE. Got a little bit excited to see.
We have a lot of
moving.
screens up right now, everybody.
Yes, we have a lot of screens here. But as I've been digging into this, so of the 25 top regional banks, they have maybe 13, 14% exposure to commercial real estate. And apparently they are well funded enough that there shouldn't be an issue. The smaller regional banks, they have roughly 44%. So there could be some other blowups. But I was talking to an expert yesterday, and he was saying it's not going to be the saving and loans crisis back in the 1990s. It's not going to be, hundreds of banks. If anything, it's not even going to be dozens, he said. He said maybe it would be a dozen. So the fact that you have this contagion trade here right now in terms of stocks down. Now, even though the bulk of them are down, the next biggest one to NYCB is down 5.9%, which is a sizable decline.
Right.
That's Southside Bank shares. But I guess what I'm saying is that the contagion may not be, it's headline contagion as opposed to actual fundamentals. A lot of folks don't think it's going to be as bad.
And it's important to understand the fundamentals of each of these names.
I want to go back.
Exactly.
I want to go back to Mike McKee on this and stay on New York Community Bank, because there are some parts of this that are tied to the Fed and to regulators. Mike, just weigh in on this with your observations.
Well, it's interesting. Jay Powell was certainly asked about banks and commercial real estate, and he said it's going to be a problem that can be worked out. They're not particularly worried about it, but it's going to take years for all this to go through the system, and there will be losses. But he was not directly asked about NYCB, either because members of Congress didn't know what was happening today, or because they realize that the Fed does not regulate NYCB. It's the Office of the Comptroller of the Currency that is NYCB's regulator. And one of the interesting things, Abby was talking about the deposit base. Most of their deposit base is insured, so it's not like SVB was, where people felt like they were going to lose their money. And the other thing about their deposit base is that about a year ago, they bought Flagstar Bank. They moved all their deposits into it, and apparently the deposits from Signature Bank, when they took that over, also went into Flagstar. Now, who knows that Flagstar is owned by NYCB? So the average person isn't rushing to pull their money out of Flagstar because they don't know the connection there.
Great point.
It sounds like the members of Congress got to get some terminals if they don't know that during the Fed
we'll
chair
have to ship them
testimony.
right down.
We did get.
If they're interested, I know where they can
call-outs.
subscribe to the terminal. Okay,
I did
Mike?
thought I heard a few call-outs there, Mike.
Yes, I mean, more than I think any other news organization, to brag a little bit, but 2 or 3 times members cited stories from Bloomberg when they were prefacing their questions.
Abigail, let's broaden it out a little bit, too. I mean, as we continue to track the trade, after we've been concerned a lot, yesterday there was a lot of conversations about overvaluations and whether or not we were kind of maybe a new trend line and so on and so forth. You know, we're going to go back to Mike in a moment because we've had a lot of economic news, and obviously Jay Powell covering a lot of the economic backdrop, if you will. Having said that, the trade, the momentum behind the groups that are moving to the upside, is it some momentum behind it?
So overall, the momentum for the markets is down. We've been talking about this for a while. The RSI, the momentum indicator, the last time we saw a high, it was last year. So all of these record highs that we've had recently, not today, but they've been made on less good momentum. And I think some of that does have to do with the Apple trade, the fact that that stock is in a correction. Now, relative to the breadth today, it's much better because we have we might even at this point, we have all 11 S&P 500 sectors higher. So it is broad-based from a volume standpoint, let's see how excited investors are about this relief from Powell, that it's not going to be a year of no cuts. So it's a little bit above average. So it is somewhat healthy. I would say, though, it's the consolidation that we saw yesterday for big tech, the worst day at one point going back to last year. It's healthy. So it wouldn't be a bad thing to see a little bit more.
And it was interesting because we saw buying into the close yesterday,
Yes.
which was really significant.
Yes.
Hey, Mike, back to you. In terms of the economic backdrop, it's still, I think, back to the last FOMC meeting where Jay Powell several times in the press conference was like, folks, it's good out there, the U.S. economy. Did we get that message very strongly as well?
Oh, well, you put it that way. We got the message, but not very strongly. There wasn't a whole lot of focus on it. It was in his opening statement that job creation has been strong, inflation's been coming down. Overall, things look pretty good in the U.S. economy. Later in the hearing, he was asked about the possibility of recession, and he says there doesn't seem to be any indication that there's any short-term risk of recession in the U.S. economy. A couple of the Democrats used their time to talk about how good the economy was, maybe from a political stance, but the economy was not front and center today. Interesting, also not front and center was the stock market. You would think that maybe he would have gotten asked about asset prices being overvalued or something like that, and that didn't really come up either. Members were more concerned about things like whether the Fed is getting involved in climate change, the housing market, maybe the closest thing to the economic issues that were talked about, and basically all Powell could say is, yeah, well, we raised rates, but as rates come down, the housing market should loosen up.
All right, so having said that, we do also get a lot of economic data points. We have been over the last couple of weeks, some data today as well. JOLT's always an important number to watch. We're going to have the Beige Book in about 45 minutes or so. Give us, remind us, Mike, about the backdrop that we continue to get in terms of some of the data points.
Well, that's the key thing. The Fed says it's going to be data dependent. They're going to look at a broad range of indicators, including jobs. And we get the jobs report on Friday. It's expected to show a relatively strong job creation continued during the month of February. They'll be looking at average hourly earnings, wanting to see if there's an inflation problem there. And then next week, we get another CPI report. Seems like only yesterday, doesn't it?
It does.
We'll get a CPI report. They'll be looking at that, and then PPI, and we'll see where inflation is. The Fed meeting's the week after that, on the 20th. They've already said they're not going to move then. So then the focus turns to the May 1st meeting, and we'll see what the numbers add up to by then. But right now, it looks pretty good. The question is, does inflation keep going down? That's going to be the one major point to trade upon.
Hey, Mike, how does this set things up for Jay Powell tomorrow when he's in front of the Senate? Do we have any indication that the line of questioning will be similar, i.e. hear more about Basel III and questions about that?
I think that's what you'll get. Senate questioning tends to be more detailed, more specific, less political, and so probably some more questions about when they might cut interest rates. But then I would imagine a lot of people are going to be on both sides of the issue tomorrow in the Senate on banking, because you can bet Elizabeth Warren is going to let the chairman know they should be as tough as possible on the banks, because that's been her position. So we may get some interesting cross arguments from members of the committee tomorrow. May get more on climate change. That's also been an issue of how far is the Fed allowed to go in what it's doing on climate change. There was one question today about the Fed and its balance sheet, but it wasn't really about when they're going to start running it down. It was more about the Fed's losses. Jay Powell saying doesn't affect our operations. It's really just a bookkeeping exercise. So we might see more of that as well. I wonder if we'll see much more political posturing. We really didn't today, which is something you usually get from members of the House.
We did see some questions about housing affordability, Mike, which I found interesting, given that things aren't necessarily going the way that economists typically think they'll go when rates go higher. Home prices should go down because mortgages become more expensive. That got thrown out the window over the last couple of years. What did you make of the line of questioning around housing affordability? Because as the point that you've made many times before is, the idea with the Fed raising rates is things do get more expensive, so demand goes down.
Well, that's the problem here, is we're in a different environment with housing than we've been in, than anybody could remember, because rates got so low. A lot of people out there, I think something like 40-50% have rates under 4%. And right now we're over 7%. So nobody wants to sell their house because they don't want to have to buy a more expensive mortgage. It was different if you were selling a 7% mortgage and you're looking at a 6 or an 8% mortgage. It's not that much different. But now it would be a huge difference in monthly payments. So everybody's just sitting there. There's no inventory on the market of existing homes. There aren't enough new homes being built. So the price goes up, simply supply and demand. They need to get interest rates down, mortgage rates down, then maybe pent-up demand to move will take over, and we'll see some additional inventory come on the market. But this may be a one-time significant jump in home prices that doesn't go away.
Hey, Mike, theoretically, at least, the Fed is not supposed to be looking at the stock market or stock prices, but one stock that's really tough to not watch is NVIDIA. And of course, for that AI play, a lot of people are thinking that AI is going to juice the economy in a massive, massive way, if not this year or a couple of years. How much did Fed Chair Jay Powell speak about AI and the possible influence on the economy?
Not very much. He was starting to get asked about it when the questioner ran out of time, and they really didn't come back to it all that much. The Fed's position is it seems to be something that will add to productivity, but we're going to have to watch it and make sure and see where the productivity comes from and what downrange impacts that has. Who loses jobs, who gets jobs, that sort of thing. They're not really ready to comment on that. There was a big conference on Friday of Fed officials in New York City, and that was one of the major topics, but it didn't come up as much as you might have thought today on Capitol Hill.
Maybe tomorrow.
One of the few people who aren't just talking about AI. Hey, Mike, just real quickly, 30 seconds. One thing that struck me is Fed Chair Jay Powell saying the pandemic's still writing the story of our economy right now, and we should be prepared to be surprised with the next chapter. A reminder that we still don't know how this all ends.
We don't. And if you keep up with some of the medical literature, the doctors are all warning it's still out there. There's still mutations, and we have to be careful. We've also changed our inventory systems, and the supply chains that we have been modified, but have they been modified enough for the next occurrence? Those are the kind of things the Fed has to worry about.
Yep, it's why we're data dependent and just kind of finding our way through. Hey guys, thank you so much. A lot of news, obviously, on this Wednesday. Great breakdown of Fed Chair Jay Powell, his testimony, first of 2 days, and of course the market reaction. Our thanks to our Bloomberg News International Economics and Policy correspondent Michael McKee in D.C. and Bloomberg News markets reporter Abigail Doolittle right in studio. We're coming back in just a moment.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. Sigh of relief on Wall Street with the Dow, the S&P, NASDAQ all advancing on a Fed Wednesday. Jay Powell once again signaling that while a strong economy will keep officials on hold for now, he does expect the Fed to cut rates this year. S&P up 45 right now at 51.24, close to session highs, up 0.9%. Dow Jones Industrial Average up 202, up 0.5%. The NASDAQ Composite Index up 174 right now, higher by 1.1%. We've got the 10-year yielding 4.09%, with a 2-year that's yielding 4.53%. Spot gold up 0.9%, 21.47 a barrel, an ounce on gold. In terms of the barrels, West Texas Intermediate crude 79.54. Did see an 80 print earlier this hour. Right now, WTI up by 1.8%. Oil stocks advancing as well. Case in point, ExxonMobil up 1.5%. ADRs of BP up 2.1%. Chevron up now little changed, up 3 cents to 149.62 on Chevron. Bitcoin keeps on going, up 6.1% at 67,191. And a headline on the Bloomberg Professional Service. Democratic Representative Dean Phillips of Minnesota is ending his long-shot primary challenge against President Biden. Recapping stocks higher. S&P up 46, up 0.9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. For those of you just joining us, you are watching an extended version of Bloomberg Business Week on this Fed Wednesday. Carol Master along with Tim Stanovic live on radio, TV, YouTube, and Bloomberg Originals. It's a Fed Wednesday because, as you know, Fed Chair Jay Powell up on Capitol Hill earlier today, first of 2 days in this semi-annual testimony on monetary policy before U.S. lawmakers. Chair Powell, Tim saying a lot of things.
Yeah, as expected, he reiterated that the Federal Reserve is in no rush to cut interest rates. Here's what he said.
We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%.
That, of course, was none other than Federal Reserve Chair Jay Powell in day one of his 2 days of semi-annual monetary policy testimony before U.S. lawmakers.
All right, so back with us with some more analysis. Longtime and resident Fed watcher here at Bloomberg economics reporter Steve Matthews. He's out there in our Atlanta bureau, and a go-to on all things U.S. rates, Bloomberg News rates reporter Michael McKenzie. He's here in studio. Steve, let's kick it off to you. Tim and I and many Bloomberg users kind of glued to our live blog today as Fed Chair Jay Powell was up on Capitol Hill. You wrote, all in all, a pretty balanced view on Fed policy that reflects where the rate-setting committee was at its last meeting. So not much new stuff there.
Yeah, it was pretty much down the middle and very similar to what you heard coming out of the January meeting and press conference and the 60 Minutes interview. You know, although it's like some people took his comments to be just very slightly dovish. I saw one report in the clip that you mentioned where Powell was talking about that they could cut rates at some point this year, that he chose the wording at some point this year as opposed to later this year. And this is how Fed watchers parse the language, because if it were later this year, that might imply maybe the second half, maybe some time away. At some point this year, that could mean tomorrow. I mean, that is totally open-ended. So
it's like managing a young kid, right? We're going to do it sometime, maybe later this year.
I also just appreciate the view into the way that, you know, Steve has to really parse everything that comes out of Jay Powell's mouth in order to understand what he's doing. And it is important, though. We laugh, but this is what traders are trading on. Hey, speaking of the trade, I want to bring in Michael McKenzie and talk a little bit about the bond market reaction today. We're seeing yields now down across the curve, Mike. Give us your idea of the way that the trade evolved throughout the day and sort of how things ended up after we heard from Powell.
Well, the trade, the market got going pretty well early on because the ADP numbers came in a little bit softer, and that was followed by 10 o'clock when the jobs numbers came in softer too, and there was a downward revision for the past month. So that gave a bid into the market, and that bid was also sustained, I think, because Powell, some people in the bond market were a little bit wary that coming into this, that Powell could perhaps reference some of the recent uptick we saw in inflation data. He didn't. He pretty much stuck to, as Steve said, the middle of the road. He kind of just, nailed the drive down the middle of the fairway. And so that combination of that data, Powell sort of maybe a touch on the dovish side, not as hawkish as people thought, that was enough to get the rally going. And then, of course, we got the news about the New York Community Bank. And again,
that's when we kind of went to, I feel like, lows of the
and
session.
then you see the sort of typical safe haven bid coming, particularly into 5s and 10s. And you can see the 2 years still above 450. It's only a little bit down on the day in terms of yield. But the belly is where people want to buy if there's any sign that the data is actually turning softer, and therefore that's going to open the way for potential rate cuts.
So kind of key that once we figure out what's going on with New York Community Bank Corp, whether or not we get this cash infusion, which is kind of floating out there in terms of some of the reporting, we're watching, we're kind of glued to our terminal to see whether or not we get a headline anytime soon. But how the market trades off of that will be more telling in terms of the real reaction to Fed policy, or no? You feel like we've got it?
I think we've got it, and I think actually, bear in mind, we've got the payroll report coming Friday, and then we've got CPI next Tuesday.
Right.
Now, if either of those reports are firmer, stronger, stickier inflation, this bond market's going to have to it's going to inch back towards the higher end of its recent range, which in 10 years is going to be back around 420, 425.
Which you've talked about a lot with us.
Yeah.
Hey, Steve Matthews, Michael McKenzie just now saying, Powell just hitting it right down the middle, kind of in the middle today. Would you say he was more hawkish? Would you say he was more dovish? Do we have to come out with some sort of different type of bird in order to describe the way that he was on Capitol Hill today?
Is he like a turducken? He's a little bit of everything?
So, some of the Fed people like to consider themselves owls because that's sort of a wise thing as opposed to hawks or doves. So that's the other bird that you hear. But I agree that he's very centrist. And the reason is when he speaks for the entire committee, the 7 governors, the 12 Fed presidents. And unless he's done a poll beforehand and talked to everybody beforehand, he really can't pivot on policy. So he basically has to reflect what the view has been, as of the last meeting. So it was a good bet that he was going to come across as being centrist, and he pretty well did. Although at an occasional point, you just saw the very slight touch of dovishness in terms of his personal view. He was asked about what more evidence that they needed to lower rates, and he mentioned that it would be just a bit more evidence. That doesn't sound like a lot. That sounds like it's just a little bit. So that was kind of came across as a dovish answer, but generally very much down the middle.
Having said that, Steve, he did say our policy rate is likely at its peak for this tightening cycle. I only bring this up because we've had guests. We've had Torsten Slok, who says we don't think the Fed's going to do any, over at Apollo, any rate cuts this year. We've also had individuals, Larry Summers and others, who say, wait, we could actually get a rate increase. Do you read that likely at its peak? Not the first time he's used the word peak, that they are done raising rates? Or again, do we have to say, ultimately, folks, they're data dependent?
Unless there's some huge inflation shock, it would be quite embarrassing and quite a change to start raising rates over again. So it's I think that their view is that they would much rather hold rates at the current level for a longer period of time than entertain the possibility of ever going higher. So it's he didn't 100% close down that option, but it's pretty clear that is not something that they want to do at all.
I did hear him, too, Michael McKenzie, reiterate the summary of economic projections, the dot plot, that when it came out in December, the median projection was for 3. Interesting 3 rate cuts this year. Yeah. Interestingly enough, we are starting to see the market move closer to that. Did you see, was there anything in there that convinced you that 3 is going to be the number today? That the summary of economic projections that we'll get next time will change at all, the median?
Sorry.
That's okay.
No, I think 3 is a pretty safe kind of number for the Fed to be talking about at this point, and based on the idea that maybe they go June, September, and December.
Let me hit the same question over to Steve Matthews while we get Michael McKenzie some water right now. What about you, Steve? Was there any indication that the next summary of economic projections, and again, we're reading tea leaves here, could actually show a difference in the median projection?
As of today, it would seem like 3 is a pretty safe bet, and you would have to wonder why would he bring the number up, which he did in the Q&A, unless they were kind of thinking that that's what they want to be, at the next meeting. But the one caveat there is the CPI next week really matters. I mean, it's like this in his prepared text, he didn't mention the January CPI. January CPI was not good at all. And if you get another surprisingly bad number, it would be harder to kind of write that off as an anomaly because you would have two bad numbers in a row. And so, that could change things. That's the thing to really watch. I mean, the jobs data, I guess it could matter a little bit, particularly if it's a really low number that kind of suggests some softness.
Right, exactly.
You hear that, Carol? He's saying they're data dependent.
T-shirts and hats, we're making them up. Got about 40 seconds left here. Michael McKenzie, got you some water, which I've been there.
Appreciate it.
It's the best of us.
We talked with you about that 10, that kind of topping out at 4.25. Do you feel like we have hit, though, the higher end when it comes to the U.S. Treasury curve, that we know where the higher ends are at this point?
Yeah, we have, unless, as Steve says, inflation does shock the upside. And I think when people like Torsten Slok are talking, they're saying they think there's going to be a reacceleration coming for the economy, and therefore wages do pick up, and therefore inflation picks up. And that's going to force the Fed, at best, to be on hold for this year. And I think that would be something that would worry the bond market. And I do think until we see really for sure that this resiliency of the economy is beginning to be chipped away, the bond market's going to be cautious. And again, I spoke to some investors last week and they said, if it gets to 440, 450, we're definitely going to buy the 10s. But they didn't rule out a test of 440, 450. They weren't so certain that you get to 5%.
It goes back to what we said with Mike McKee. Jay Powell saying the pandemic's still writing the story of our economy. We don't exactly know how this all lands. Guys, thank you so much. So appreciate it. Steve Matthews, economics reporter at Bloomberg News, out there in our Atlanta bureau, and of course our Michael McKenzie, rates reporter at Bloomberg News. Tim here in studio.
Hey, let's get a check on the latest world and national news. We got Amy Morris standing by in the Bloomberg 99.1 newsroom in D.C. Hey, Amy.
Hey, Tim, thanks so much. A Russian missile strike has landed near Ukraine President Zelensky's motorcade in Odessa. It's where he's meeting with Greece's prime minister. It was very close, but nobody was hurt. In front of a House panel today, Federal Reserve Chair Jerome Powell was asked if he believes there won't be a recession.
There's always a meaningful possibility that an economy will fall into recession. I don't think that possibility, though, is elevated at the current time.
Powell told lawmakers the central bank is in no hurry to cut interest rates until policymakers are convinced they've won their battle over inflation. After some overwhelming losses, GOP contender Nikki Haley is ending her campaign with a thank you to the American public and a warning for members of her party.
Our Congress is dysfunctional and only getting worse. It is filled with followers, not leaders. Standing by our allies in Ukraine, Israel, and Taiwan is a moral imperative. If we retreat further, there will be more war, not less.
Haley indicating she will not immediately endorse Donald Trump. You can add acne treatments to the list of widely used consumer products found to contain high levels of benzene, a chemical linked to cancer. An independent lab wants the FDA to recall the products. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
connection lost.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. Shares of New York Community Bank Corp, they do remain halted. Last trade down 42%. NYCB said to be trying to raise equity capital to help restore confidence in the beleaguered company. This according to the Wall Street Journal, citing sources. We'll have a whole lot more on this story coming up with our Herman Chen to discuss NYCB. As of right now, though, the stock is halted. The Dow, the S&P, NASDAQ, they're all rallying. It is a Fed Wednesday, and traders are breathing a sigh of relief. Jay Powell once again signaling that while a strong economy will keep officials on hold, he expects the Fed to cut rates this year. The S&P up 37, up 0.7%. The Dow up 141, up 0.4%. The NASDAQ Composite Index up 141 points now. That is a gain of just about 0.9%. 10-year at 4.09% with a 2-year that's now yielding 4.53%. Gold up 1.1%, 21.51 the ounce. West Texas Intermediate crude up 1.6%, 79.39 for a barrel of WTI. Bitcoin up 5.8%. Bitcoin at $67,000. Again, recapping, U.S. stocks higher across the board. S&P right now up 38, up 0.8%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. You're watching and listening to an extended edition of Bloomberg Business Week. Tim Stenevec along with Carol Massar live on Bloomberg TV, radio, YouTube, and on Bloomberg Originals. Well, moving to another big story on this Wednesday, and that, of course, is the aftermath of Super Tuesday. President Joe Biden and Donald Trump prevailing in almost every Super Tuesday nominating contest and are set for a rematch in a general election that few Americans are excited about, and one, Carol, that Wall Street donors tried in vain to avert.
Absolutely. GOP contender Nikki Haley, as expected, ending her campaign after the Super Tuesday races, ending it this morning after those overwhelming losses. She spoke earlier from her home in South Carolina. Let's listen in.
It is now up to Donald Trump to earn the votes of those in our party and beyond it who did not support him. And I hope he does that. At its best, politics is about bringing people into your cause, not turning them away. This is now his time for choosing.
All right, that, of course, is Nikki Haley speaking earlier this morning from her home state of South Carolina. Well, covering it all last night, continuing to, of course, the post-Super Tuesday races. The host of Balance of Power, one of the hosts, Joe Matthew, joining us now from our D.C. bureau. So, Joe, good to have you here. Had some time to kind of digest all of it. It feels like it kind of went as expected, largely.
Largely, if not even more for Donald Trump than some saw. There was a thought
early yesterday, even into the evening, that Nikki Haley could pick off a couple New England states. Instead, we're spending the evening obsessing over Vermont, which tells you a lot about where we are in Republican politics, the home of Ben and Jerry. But look, it just became clear that the window had closed. It would be mathematically essentially impossible for her to close the deal here. And now America is getting exactly what it did not want, which is a rematch between these two old men.
Well, perhaps it's what a lot of voters do not want, but it's what a lot of voters will likely end up getting, Joe. And it's going to be a long and extended primary season. What did we learn from exit polling last night, or a long general election season, I should say, when these two do get nominated at the conventions? What did we learn from exit polling last night about the type of voter who came out for Nikki Haley and how they perhaps could vote in the fall?
Well, it's interesting. She had a number of states last evening where you had folks other than Republicans allowed to vote, and she saw some love in those states. The poster child of them would be New Hampshire. But look, she's got fewer than 100 delegates. That's not exactly a brokered convention, and Donald Trump has had a commanding lead. We've never seen, we have to acknowledge, never seen this happen before, where a candidate, like an incumbent in this case, came in and just ran the table like this and swept all the early states. Iowa, New Hampshire, South Carolina, that alone was a feat. And so the writing is obviously on the wall here. But we did see some weakness, hear about some weaknesses potentially for Trump in those exit polls, Tim, that you're asking smartly about here. In Virginia, North Carolina, and California, the exit polls included this question: if Donald Trump were to be convicted of a crime, would you consider him fit to be president? In Virginia, 37% of Republican voters said no. 31% in North Carolina said no. In California, 23% of Republican voters said no. And that tracks with our polling at Bloomberg and Morning Consult. That's why this Alvin Bragg case that's going to start in New York later this month is so important.
So, Joe, is it safe then to make an assumption that if indeed the former president in this race running for another term in the White House, if he is not convicted of anything or found guilty of anything further in terms of the January 6th insurrection and so on, that we should assume that all of those who voted for Nikki Haley so far will automatically go to Donald Trump?
No, absolutely not. Some will, but there's a reason why they were voting for Nikki Haley. She was the alternative. And it's not clear that they'll go to Joe Biden either. There's a question of whether they stay home, whether they keep that top of the ticket blank, like we saw many Republicans do in Georgia in 2020 and vote Republican all the way down the ballot. Then there's, look, RFK Jr. is waving at them. Maybe there's a no labels candidate that gets into this race. That's the group that they would be aiming for here. But in terms of American politics right now, this is a two-party system. That's where the money is going. And it's hard to see this being larger than a Trump versus Biden race.
So it's a Trump versus Biden race, but if there is some sort of third-party candidate, an RFK Jr., for example, who does he then pull votes from? Would he be pulling votes from President Biden? Would he be pulling votes from former President Trump? Or would he be getting people who wouldn't have actually voted in the general election to come out and vote?
Well, it's a great question. Everyone's trying to answer that, and it really depends on who he or she is. If you're specifically asking about RFK Jr., it looks like, according to some research, it's a wash. He's politically closer, interestingly, to Donald Trump when you get, the anti-vax crowd in there and others. It aligns more with a Republican voter or a libertarian voter. But a lot of folks think this is the Kennedy family that they associate with Joe Kennedy and Bobby Kennedy and JFK. And if they're not paying attention, you remember that Super Bowl ad that stole from the old Kennedy? They might make that connection and take votes away from Joe Biden. So that one seems to be a wash. The no labels potential is the great fear of Democrats. If you get a unity ticket, that appears to be coming out of Joe Biden's pocket.
Joe, Matthew, you've seen lots of political races. You're in it. You love this stuff, the ins and outs, if you will. But what is it to have a race, a rematch that really many of, or a significant portion of the American voter doesn't even want?
That's the wacky thing about this, because we've really never done this before, at least not with this kind of research, to know how toxic both seem to be to a majority of voters here. Coupled with the fact that, we've got two incumbents running against each other, essentially. We have to look at it that way. Certainly a president and the most previous president, we haven't seen that since the 1800s. So a lot of the conventional wisdom guys, kind of doesn't matter. History is not really a great guide here because this is new for us. When you add social media at the 24-hour news cycle and everything else behind this, and the pull that Donald Trump has with his own avenue directly to voters, it's simply something that we've really never seen.
Joe, just in the last couple of minutes that we have with you, what's the most important down ballot result that we got last night? Is it California Senate and that runoff?
Yeah, for sure. For sure. Everyone wanted to know who was going to be running against Adam Schiff. And it's the fact that it's going to be Steve Garvey, a former ball player without a political career behind him, is going to be in a very interesting and very expensive race to watch. Also, though, this Colin Allred race against Ted Cruz, I mean, look, it's Ted Cruz's race to lose. We're talking Texas, after all, and there doesn't seem to be necessarily a big clamoring. Beto O'Rourke, as a Democrat, couldn't unseat him, but that's going to be wild, expensive and wild. Watch as well the governor's race in North Carolina. That's where the big money is going. Those three from last night will be a lot to cover in and amongst themselves.
Joe Matthew saved you 30 seconds. We've been fooled by polls before, and so we kind of throw them around, and we love to talk about them and what they kind of say about maybe how things go. Do they get more accurate? I mean, I don't know. As we get closer, how are you thinking about the use of polls this time around?
Just depends on the poll. You know, look at the size of the sample and whether this is a state or national polls we're talking about. The national stuff can bring a lot of noise, and as Charlie Cook reminded us last night, can inflate the standing of a Democrat with big states like New York and California. Watch our poll. Those 7 swing states are likely going to decide the presidency, and Donald Trump is leading Joe Biden in all of them right now.
All right, this is why we love talking to you. Man, he sleeps it, eats it, dreams about it. It's just great
Whether
stuff.
he wants to or not.
Whether you want to or not. Joe Matthew, so appreciate it. One of the hosts of Balance of Power, of course, coming your way later on today. Joe Matthew joining us there in our D.C. Bureau. Shares of New York Community Bank are, by the way, still halted pending some news, so we're keeping an eye on that. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
All right, everybody, we are getting ready to wrap up on this extended edition of Bloomberg Business Week, at least for the focus on Jay Powell, although it will continue in the next hour as well. Carol Master along with Tim Stenovec live on radio, TV, YouTube, and Bloomberg Originals. Quick check on the markets for you, and you've got stocks definitely off their best levels of the session. What does that mean? Well, the S&P 500 still up about 25 points, 5103, your last print there. NASDAQ, we're looking at a gain of about 0.6%, a gain of about 98 points. But what's interesting in terms of what we've seen on the yield side is that we've definitely seen a pullback in yields all along the curve. That 2-year note with yield of 4.53, the 10-year note right now yielding 4.08.
Okay, so one more to add to the list, Carol. The NASDAQ 100, completely flat right now. Not moving higher, not moving lower.
Which is kind of interesting because we did see some
earlier,
right, a bounce back in some of those mega cap tech names. In the meantime, of course, top and center is what we got from Fed Chair Jay Powell up on Capitol Hill. He'll be there again tomorrow before the Senate Banking Committee, again taking questions from senators. But, you know, net, basically, he says our policy rate is likely at its peak for this tightening cycle. That is a quote. He also said it will likely be appropriate to begin dialing back policy restraint at some point this year. So markets kind of, in terms of rate expectations or rate cuts this year, kind of expecting still maybe about 3 cuts this year.
That's exactly right. Futures still pricing in the likelihood of the first Fed rate cut coming in June. We did see the S&P 500 up 0.8%, a little earlier in the hour at about 1:15 today. The NASDAQ 100 did climb up to 1%, now flat, and the S&P 500 now up just about 0.5 percentage point.
I think what's interesting, too, is once again, and we've heard this from other members of the Fed and certainly from Jay Powell, this idea of risks in moving too quickly or aggressively in terms of cutting rates, which he said if it caused inflation to accelerate could require even tighter policies. So there's that. But he also pointed out again, Tim, that there are risks in moving too slowly as well, right? You don't want to keep rates too high for too long. And if we do get a slowdown, that any kind of slowdown to come, or dare we say recession, that it's going to be deeper and longer. So it's a delicate balance, and many would say it's tougher as you get near the end of that rate cycle, but nonetheless, that's something that's on Fed Chair Jay Powell's mind.
Economics reporter Steve Matthews earlier in our program reminding us that there is still a lot of data to come before the next meeting. Of course, the February jobs report, we get that on Friday, Carol. We got JOLTS earlier today. In the next week, again, CPI. So once again, the Fed waiting to see more evidence that the economy is cooling a little bit. Michael McKenzie making that point on our program earlier as well, before it does commit to cutting rates.
Yeah, and exactly, repeating that guidance from that last FOMC statement that policymakers will assess incoming data, the evolving outlook, and the balance of risks as they set policy. So as we kind of joke here, but it really is no joke that the Fed chair has consistently kept to that message of being data dependent throughout this cycle. And so they're going to watch. We've got a monthly jobs report on Friday. That's a big one. A reminder that we get another inflation print, CPI, next week. So again, we'll get another indication of whether or not inflation is settling down or whether there's still concerns about some of the pressures that are out there, Tim.
The Fed chair was also asked about the possibility of a recession coming later this year. He did say that recession risks are not elevated in the near term. He also was asked about a soft landing for the economy, and the Fed chair did say the Fed would not make such an official declaration, but the Fed is monitoring commercial real estate issues, he said, as he was asked about that.
Yeah, and what's interesting, too, is the Fed expecting continued growth at a solid pace. I heard the surveillance gang this morning, like, not willing to say Goldilocks economy, but it is interesting in some of the strength that we continue to see, whether it's consumer spending or the labor market, that does necessarily give the room to the Federal Reserve, the U.S. Central Bank, to maybe hold off on cutting rates because the growth is still there, and they want to make sure that they get this inflation right. And, you know, we talk about that 2% target. Inflation has eased substantially, no doubt about it. Take a look at a 12-month chart, and you can see how much it has come down in the last year. But the Fed remains strongly committed to bringing inflation back to that 2% target, so not looking to reassess that, at least not at this point.
Interesting questions, too, from lawmakers actually about immigration and the effect that immigration does have on inflation. The Fed chair stopped short of saying that more people coming into the country will necessarily bring inflation down because those people also buy stuff. He made the point, but he did say that as people do get added to the labor force, then there are more
not
workers.
so tight.
Exactly, it doesn't become as tight. Hey, speaking of tight and payrolls, we are expecting that number, of course, on Friday. 200,000 is the number that economists expect. This is a survey of Bloomberg economists. Remember a survey of economists by Bloomberg, I should say. Remember last month, that number at 353 came in so much higher than every economist surveyed by Bloomberg expected.
Front and center. Hey, front and center also is New York Community Bank Core. Let's not forget that it is still halted pending news. The last trade, it was down more than 40% here. Of course, this is something we continue to talk about. It did drop as much as 47% before that halt earlier today. The beleaguered commercial real estate lender trying to raise capital to restore investor confidence. Bankers are gauging investors' interest in buying stock, according to a person familiar with the matter saying earlier today, company is said to be working with advisors, including Jefferies Financial Group, according to those in the know. So again, halted. We've been watching. We've kind of been glued to the Bloomberg because it's been halted for some time, I think over an hour, maybe an hour and a half at this point.
Well, let's remind everyone where we are. The shares thus so far this year have lost more than 3/4 of their value. This after NYCB slashed its dividend and set aside more provisions than expected for loan losses. And then, if you recall last week what happened, the firm announced that it was replacing its CEO and also that it had identified, quote, material weaknesses in how it tracks its loan risks.
Right, and we have seen also some pressure along all of the regionals. I'm looking at the KRE Regional Banking ETF. It is down about 2.2%, so we're seeing some of the concerns spread throughout the sector. But we'll obviously break the news when we see it cross the Bloomberg and get an update on New York Community Bancorp. Don't go anywhere, anyone. We'll continue to track the markets, New York Community Bancorp, and more analysis of what we got from Fed Chair Jay Powell.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everyone. Bloomberg Business Week continuing on radio, TV, YouTube, and Bloomberg Originals on this Fed Wednesday, March 6, 2023. Keeping a watch on the Fed, we are expecting the Beige Book to cross the Bloomberg terminal at any moment. So looking for that, and we'll break some of those headlines as they come across. But the Fed, of course, in focus. We're just coming off of the testimony from Fed Chair Jay Powell, of course, up on Capitol Hill, basically reiterating much of what we got from that last Fed meeting.
Yeah, his semi-annual testimony before U.S. lawmakers. As you mentioned, Carol, we're waiting on the Fed Beige Book. We'll get those headlines when we got them. We're continuing to watch the U.S. economic data that came in this morning. That will come in on Friday, surrounding Powell's comments. Also, as we mentioned, New York Community Bancorp, top of mind, shares sinking as much as 47% before a halt in trading. Shares continue to be halted, but we are going to be checking in a little later with Herman Chan over on our Bloomberg Intelligence team, getting an understanding of what's going on with New York Community Bank.
It's a busy Wednesday, and folks, we're going to continue to also track some of the thoughts in terms of Super Tuesday. Here's a couple of headlines. Federal Reserve releasing the Beige Book of U.S. economic conditions, economic activity increasing slightly on balance. So that's one headline we're just getting. They're slowly starting to come across. So again, a survey of regional banks across the 12 Federal Reserve districts. So as more headlines come across, we'll bring them to you. In the meantime, let's get another check on what's going on in the trade. Here's once again Charlie Powell.
Hi, thank you very much indeed, Carol and Tim. Higher across the board, but on a busy Wednesday, want to add one more story into the mix. That involves Tesla and its German plant. We're now learning, just getting word that the plant will have no power until the end of next week. This according to the Bild publication. Tesla shares, they are trading lower on an update for the rest of the market. Tesla right now down by 1.8%. The Dow, the S&P, NASDAQ, they are all pushing higher, with the S&P up 27 right now, a gain of about 0.5%. We've got the Dow up 76, up by 0.2%. The NASDAQ Composite Index up 104, higher now by 0.7%. 10-year 4.09%, the 2-year 4.53%. Spot gold up 0.8%, 21.45 the ounce. West Texas Intermediate crude was trading with an 80 handle earlier in the session, 79.32 right now on WTI. It is is up by 1.5%. Bitcoin up now by 5.9%, 67.47 right now on Bitcoin. Bottom line here, stocks higher across the board. The Dow, the S&P, NASDAQ all advancing. The trading halt on NYCB does remain in effect right now. Last trade with the stock down 42%. Again, recapping here, stocks higher, S&P up 25, up 0.5. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, for those of you just joining us, of course, we are just getting some headlines from the Fed Beige Book, several reports citing heightened price sensitivity. They're slowly coming out. I'm sure Michael McKee has read all of what the survey said, but let's head to him. Bloomberg News International Economics and Policy Correspondent Michael McKee back in our D.C. Bureau. Good to come back to you, Mike. Having some fun with you. There's a lot of information there, but what so far has jumped out for you in terms of the Beige Book?
Well, I've read the whole thing. Now I'm just coloring in the pictures.
I figured.
No longer beige.
Always can count on you.
It reads a little milquetoast, is the way I would put it, I guess. It doesn't take strong positions on any particular economic data point, but suggests that the economy is continuing to do reasonably well. Nothing to worry about going either direction. And of course, the Fed has placed a resurgence in growth as one of their risks lately. The overall way they describe the economy is economic activity increasing slightly on balance since early January. 8 of the 12 districts reporting slight to modest growth in activity. Consumer spending, particularly on retail goods, they say inched down a little bit in recent weeks, but manufacturing activity was largely unchanged and bottlenecks continue to go away. They did mention that consumers and businesses have a little more price sensitivity these days. And when they talk about prices, which is kind of the important thing to the Fed right now, they're talking about price pressures continuing to persist during the reporting period, but there's some degree of moderation in inflation, and that companies are having a harder time passing along price increases because consumers have gotten more price sensitive. They also note that while there are some increased freight charges, the disruptions in the Red Sea and the Panama Canal don't appear to have a major effect on supply chains or costs for imported goods at this point. So that is good news. And in terms of course, employment continues to be relatively strong. There are more applicants than there had been, so it is getting easier to hire, but it is not like there is any kind of real bottleneck anymore there. Wages sort of flattening out a little.
Mike, hey, hang on a second, because we do have a headline crossing. This has to do with New York Community Bancorp, and we are getting a headline that it is raising more than $1 billion in equity led by, I'm assuming, Stephen Mnuchin's firm. New York City Bank, Community Bancorp investors include Liberty Strategic, Hudson Bay, also Reverent. So the headlines are starting to come out. I'm just
We're
looking
still
to
seeing
see,
trading paused at this point.
which makes some sense. The stock was down 42% before these news, but before these headlines.
Mike, we have you here, so I do want to get your reaction to this because New York Community Bank not specifically brought up during Powell's testimony, but you made the point earlier on our program today that there were concerns raised about community banks.
Well, there are concerns raised about banks which have exposure to CRE. Jay Powell said that the largest banks are not really a worry. It is the smaller banks that might have some problems, but he didn't think it was a systemic problem. There would be some individual losses, but at this point, it's something that they can work through. Will take some time, but they can work through it. Now, the NYCB is seen as a really idiosyncratic bank, given what their market is, given what their business model is, basically lending to multifamily housing in the New York City area. And so it's not seen as a systemic issue, which is why I guess you're not seeing a big follow through with other banks going down in the same way we saw last March when SVB was going down and there was a lot of pressure on other banks. Interesting about the $1 billion bailout. At least money being put into it because Republic Bank did that, you remember, and it didn't work. So there's a lot at risk here, I guess, for some of these investors, but the feeling may be that, again, this is idiosyncratic on the other side. It's a certain problem that can be fixed with enough capital. Maybe that is the reason for optimism from those investors.
Right. And we should add into another headline crossing New York Community Bank Corp rep saying that Stephen Mnuchin will join the board of directors. Keep in mind, he is the managing partner and founder of Liberty Strategic Capital, which is one of the investors that are raising that more than $1 billion in equity that is being led, though, by Stephen Mnuchin's firm, Liberty Strategic Capital. Again, shares of New York Community Bank Corp have not resumed trading, so we'll continue to keep our eye on that.
Hey, I want to bring in Henrietta Trey's, Director of Economic Policy Research at Veda Partners, joining us from New Orleans. Henrietta, good to have you on the program. Forgive me, but I do have to ask you about New York Community Bank because this is front and center for us. I know you've been watching economic policy and you've been watching the Fed, but what does our investing audience need to understand about a cash infusion like this into a bank that has exhibited specific weakness when it comes to a certain type of loan?
Especially when it comes from an infusion, as you just discussed, that didn't work the last time around. Yeah. The question that I most frequently get from investors and clients is, what is Congress going to respond to this? How is legislation going to pass? Will there be any kind of influx or moves at the Fed or any of the other federal agencies to try to stall out any kind of systemic risk? I'm not hearing about that generally on Capitol Hill. It seems to be isolated. And I think maybe adding to that is the inability of Congress to do anything much beyond just keeping the lights on at this point. We're too deep in the election cycle. So I do think that a focus on regulatory actions is something that Powell indicated we're going to see later with Basel III or later on this year. And I think that's probably the main focus, if anything, is going to come of this. But sort of the hands-off approach is what I would anticipate right now.
When you think about, though, the outlook and the economic outlook, Henrietta, we continue to keep an eye on the financial sector, and in particular the regionals, because it was just roughly about a year ago, right? Then they all became front and center for us. How does potentially, if we see others that come into some concerns or continuing to come into some concerns, how does that impact your economic outlook?
What happens is actually you see almost an immediate partisan split about how to approach this. What I remember from SVB and the way that this sort of culminated in DC was you needed to have widespread, systemic, rural focused, agriculture oriented lending impacted. It couldn't just be a region specific bank. The last time around, it was very tech heavy and sort of relegated to Silicon Valley, and that allowed Congress, DC, and just sort of the macroeconomic picture to say, hey, this is confined, this is contained. We don't need to worry about it from a systemic perspective. The economy right now is doing sort of exactly as you just said, milquetoast understanding of what's happening. We have very strong GDP growth at 3.4, I believe it was, 3.2, 3.7% unemployment, 3.1% inflation. Just to sort of wait and see, expect that things will fall off. But unless it becomes widespread and systemic and hits everything, not just regional specific banks, you're not going to have a response.
Let's just rehash. New York Community Bank Corp plans to announce an equity investment of more than $1 billion led by Stephen Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners. That's according to a spokesperson for the bank. Liberty will invest $450 million, Hudson Bay $250 million, and Reverence $200 million as part of that transaction, according to the spokesperson. In connection with the deal, New York Community Bank Corp will add new directors to its board, including Mnuchin and Joseph Otting, former comptroller of the currency. We are still awaiting shares of New York Community Bank Corp to resume trading. Keep in mind, they were down more than 40% before they halted about an hour and a half, maybe almost 2 hours ago.
Hey, I want to go back to Michael McKee, International Economics and Policy Correspondent, standing by in Washington, D.C. Mike, we brought up Silicon Valley Bank and First Republic Bank because we're really almost at the one-year anniversaries of when that crisis happened. But a point that you continue to make is that this bank is very different from a couple of perspectives. It has to do with deposits, and then it also has to do with the different type of bank that is under New York Community Bank.
Yeah, New York Community Bank is a holding company now. They put together a series, I think, of about 9 community banks in the New York area that basically made loans to multifamily housing stock, the kind of thing that you see everywhere in New York, the brownstone kind of thing. And there have obviously been some issues with people being able to pay higher rates because the mortgage rates have gone up, that sort of thing. So they have a different kind of business model than most of the others. this is not a problem with deposits
Right.
as SVB and Republic had. And we were talking earlier about how they've got a different setup because it's a bank holding company. Their deposit-taking institution is Flagstar Bank, and they haven't had a problem. They did years ago, but they haven't had a problem lately. And people don't connect the two, so there's no kind of run on the bank. And even if there was, the FDIC notes that most of their deposits are in the insured category, which was not true for SVB. Of course, they've raised the insurance level since SVB, but it doesn't seem like the ingredients are there for any kind of spreading fire.
All right, guys, we're going to leave it there. So much appreciation. Michael McKee, International Economics and Policy Correspondent at Bloomberg News, and Henrietta Treyes, Director of Economic Policy Research at Veda Partners. Just to rehash our top story, I would say, safe to say here, on this Wednesday, New York Community Bank Corp planning to announce an equity investment of more than $1 billion led by Stephen Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners, according to a spokesperson for the bank. Liberty will be investing $450 million, Hudson Bay $250 million, Reverence $200 million as part of the transaction. Also, NYCB will add new directors to its board, including Stephen Mnuchin and Joseph Otting, a former comptroller of the currency. The board of NYCB to be reduced to 9 members, and this transaction to close on or around March 11th. And a quick check in terms of shares of New York Community Bank still halted, but we are getting some more details here, and we'll continue to follow it as they cross the Bloomberg.
Yeah, New York Community Bank also to sell and issue shares at $2 per share and named Joseph Otting as the company's CEO. For more, let's bring in Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. Regional Banks. Herman, a lot has happened just in the moments that you sat down in our studio this afternoon. Is this infusion enough to save New York Community Bank?
Look, it does offer a lifeline for them, especially given the way the stock has traded over the past few days. That being said, the existing equity shareholders have been massively diluted. We're talking about a bank that has a bit over $1 billion in market cap, and they're raising over $1 billion with this equity infusion. So it's a tough pill to swallow for the shareholders that were riding it. But it does give them some time to shore up all the issues that we've talked about.
Explain what this does to existing shareholders of the bank. If you're offering new shares at $2 per share,
right,
and at a $1 billion value, what does it do to existing shareholders?
Right. So basically, your ownership of the earning stream is now down by 50%. Okay. So it's great for the company that it can still operate given all the uncertainty, but it's just a changing of the guard and changing of the shareholders.
Getting $1 billion lifeline, does that guarantee that this is a bank can continue to exist? And I don't want to be inflammatory, I want to be smart here, but $1 billion is a lot of money. Is that enough to fix the balance sheet and the risks that are out there?
It really depends on what's going to happen with the deposits. Right now, it should placate a lot of folks that were maybe a little bit uncertain about what the path is ahead, but we've changed the management team yet again. There's a new CEO now with Joseph Otting. He's got a lot on his to-do list to shore up its capital even more, reduce their exposure to commercial real estate, and make sure their employees and customers stay within the bank. So that's a lot.
We just had a new CEO join New York Community Bank, Sandro Dinello.
Right. So Sandro looks like he's out now, and Joseph Otting has been announced the new CEO. Sandro will remain as the non-executive chairman of the board.
Can I ask you, when we've talked about this before, when we initially got that headline, was it a couple of days ago or so, about material weaknesses, and we had this conversation that that's what a bank's supposed to do, right, in terms of risk oversight. So, I mean, do we know whether or not that they've fixed that problem? Does a cash infusion just fix that problem?
It doesn't. So that's also, I should have mentioned earlier, on the to-do list.
And forgive me, about 30 seconds here.
Sure. And so that's something, Joseph Otting was former head of the OCC, and they're regulated by the OCC. So that should give them a good plan to go ahead and make sure their regulatory issues are dealt with in a proper manner.
We should also mention another headline crossing. Investors include Citadel Securities. So reaching out to a bunch of members of kind of the financial community.
That's right.
All right. What's next on your radar?
You know, this has taken up so much time. So we're just looking for the fallouts ahead. We've got a webinar going on tomorrow about the year after with SVB.
All right, going to look forward to that. Herman Chan, thank you so much. A member of our Bloomberg Intelligence team watching these regionals for us. Again, shares of NYCB not trading yet. This is Bloomberg Business Week.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. Let us update you and reset with what is happening with New York Community Bank. It plans to announce an equity investment of more than $1 billion, led by Stephen Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners. Importantly, shares of NYCB do remain halted right now. NYCB, last trade that we've got on the Bloomberg, down 42.2%. Liberty, by the way, is going to invest $450 million. Hudson Bay, $250 million, and Reverence, $200 million, all a part of the transaction. And finally, one more important headline in connection with the deal: NYCB is adding new directors to its board, including Mnuchin and Joseph Otting, the former controller of the currency. Again, shares of NYCB are halted right now, pending this breaking news. The Dow, the S&P, NASDAQ all higher on a Fed Wednesday. You heard Jay Powell live on Bloomberg Radio and Television, with the S&P up now by 0.5%, up 25. That is a gain to 5104 on the S&P. We've got the Dow up 44, higher by 0.1%. NASDAQ Composite Index up 106, higher by 0.7%. 10-year 4.10%. The 2-year right now 4.55%. Spot gold higher by 0.6%. 21.41 the ounce. West Texas Intermediate crude oil up 1.3%. 79.18 a barrel. And Bitcoin keeps ripping higher, up 5.8%. 67,015 right now. Another volatile day for Bitcoin. Again, recapping, stocks higher. S&P up 26, up 0.5%. Shares of NYCB halted. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie, of course, breaking down New York Community Bank card. We continue to watch for any additional headlines on this over $1 billion equity raise led by Stephen Mnuchin's firm. The stock still halted, so we'll continue to keep our eyes on the Bloomberg and bring them to you. In the meantime, as you know, a busy Wednesday. We are also talking about politics, which are front and center as well for investors, and what happened after Super Tuesday, which largely, Tim, went pretty much as many expected, but a rematch it looks like at this point.
Yeah, perhaps the only surprise was just how much Donald Trump did trounce Nikki Haley. We should say that Haley exited the race for the GOP presidential nomination after a near sweep of Tuesday's races by Trump. She did not this morning endorse Trump in her remarks as she announced the end of her campaign. She did say that the former president would need to, quote, earn the votes of those in our party and beyond it who did not support him.
She did indeed. Well, with more on Super Tuesday and the aftermath, and what is next, one of the hosts of Balance of Power is also with us at this point, Kayleigh Lyons, joining us now from Washington, D.C. You know, Kayleigh, we talked with your partner in crime, Joe Matthew. It went really largely as expected, but I do love asking you guys who watch the ins and outs, who pick up on the nuances that maybe others don't. You know, what struck you following the results of last night's races and kind of where we go from here?
Well, a lot of this came down to the fact that Nikki Haley just wasn't able to win any single state other than Vermont, and of course the DC primary, which she had won the weekend before. That said, though, she was capturing a pretty significant share of voters. Sure, not 50% plus, which what was needed to take the delegates in the majority of these states, but still we're talking 20 to 30% of the Republican primary electorate who was specifically not choosing Donald Trump, who for all intents and purposes in this contest is a Republican incumbent. And that, I think, is what is really the question as we now move forward into what frankly is a general election contest, a really long one between Trump and Biden, this rematch of 2020. Where do those voters go? The ones who were not choosing him in the primary race, how many of them that were backing Nikki Haley actually would vote for him in November? Would any of them vote for Biden, or will they be looking for option C, whatever that is? Maybe it's Robert F. Kennedy Jr., maybe it's no labels should they decide to run a unity ticket, but both Trump and Biden today are clearly going to be making a grab for those voters.
So I guess the question that I have is about the electorate in the primary, Kayleigh, versus the electorate in the general election. Because what we've learned in primaries in recent years is that we see, I don't want to call them extreme wings of the party, but we do see we don't necessarily see independents, we don't really necessarily see their voices being reflected because this is our primary system. That's just the way it works. What about those independent voters come the general election who are not passionate about either candidate? What do we know from polling about where they go?
Yeah, well, Tim, it's interesting because some of these primaries that were in question yesterday were open or semi-open, which means those independent voters, even some Democrats, could actually show up and vote for a Republican candidate. A lot of those people, though, were more protest voting against Trump, according to the exit polls we have seen, than voting for Nikki Haley herself. But to your exact point, these are primary elections. These are some of the most engaged of the electorate that would show up at a random day. Engaged. It's a random day. Some of them were voting in January, February, early March, braving weather. These were people who were always going to get out and vote. The question is, how many more people could turn out and vote in November? When we are talking about a contest here, Trump, Biden, more than 70% of Americans say they don't want either of these candidates. Does that just mean a lot of people don't make any choice? They just sit at home. Or could they be looking at a ballot and not vote for someone for president, even if they're voting for their other elected representatives down the ballot? It could really be a turnout question we are dealing with here.
Kaylee, but how much of the legal overhang and how the legal outcomes for the former president, Donald Trump, how that ends up playing out, how much of that will impact ultimately, how people vote come November?
Well, it could have a really big impact, theoretically. Our polling here at Bloomberg, together with Morning Consult and 7 key swing states, really the states that, because of the Electoral College, are probably going to end up deciding this election, show that a significant amount of those swing state voters would not vote for Donald Trump if he were to be convicted of a felony. And if you even look at some of the exit polling from Super Tuesday from the likes of NBC in states like North Carolina and Virginia, a significant chunk of Republican voters said they would think Trump would be disqualified from being president, from earning their vote, if he were, again, to be convicted of a felony. That said, it becomes a real question of whether or not that's going to happen. We know the trial in New York, the state trial Alvin Bragg has brought related to hush money payments paid to porn star Stormy Daniels, does begin at the end of this month, March 25th. So theoretically, that could be the only case to go forward, as we're still dealing with delays in the other cases. The Supreme Court isn't going to hear the immunity question that would allow the D.C. case here related to 2020 election interference to go forward until the end of April. And who knows when they could actually rule on that, so a trial could be scheduled.
One thing I'm curious to Kaylee about is what's the role of Nikki Haley going forward? She's been very critical of both Donald Trump and Joe Biden. So I'm curious, what's the expectations around that? Does she just go kind of away quietly, or is there a role for her going forward?
Well, this is the question. Could she want to join a second Trump administration, considering it was under Trump that she served as ambassador to the United Nations? It was very telling that she did not come out and endorse him today. As Tim said, he said that he needs to earn the votes of those that were voting for her. She said she congratulates him and wishes him well, but came up short of actually giving her full-throated support for him. As for the role that she could play going forward in this contest, surely there is still an open question, even though she suggested she didn't want to join a no labels ticket. So just watch and see if we get any news in that regard. But a lot of this is about her more distant political future, not necessarily for the rest of 2024, but 2028. Keeping in mind that she had been still pulling in millions of dollars from donors up until last night. That is money she could use in a future contest should she decide to throw her hat in the race again. And that was probably a lot of the calculation she was making when she decided to drop out today. Do I want to keep chugging along, knowing that the math is not going to work to actually secure the nomination, or do I want to take the name recognition I have already gotten and decide I'll try again next time?
Kaylee, even though it's looking more and more like we're going to see a repeat of what happened in 2020 when it comes to the general election, a lot has changed since 2020. You have President Trump's legal issues, some of which you've talked about, but you also have the court's ruling, the Supreme Court's ruling on Roe. And we know how that has affected the way that Republicans have done in special elections and in the midterms. And it wasn't good for Republicans. What do we know about the way that this could go in the general election if perhaps we start to see independent voters associate the change in Roe and what happened in Alabama with IVF as part of a Republican representation on the ticket?
Well, Tim, this is such an important question, and I actually asked a question like this to Celinda Lake, a really famed Democratic pollster, last night, and I said, look, we know what happened in 2022 in the more immediate aftermath of Roe. The abortion issue was, being overturned. The abortion issue was a galvanizing force for Democrats. It is why they performed better in those midterm elections than was expected. Does it have the same potency as you get farther removed from the actual Dobbs decision? And she said it keeps coming back up to the forefront of public thought because of exactly like you were just mentioning, Tim, Alabama's Supreme Court making a decision about embryos frozen being children that impacts IVF and female reproductive rights in that regard. We keep seeing the aftermath of the Dobbs decision showing up in various states, which could keep it more forefront of mind. All that said, though, we don't see abortion ranking as highly in polling as other issues when it comes to what's on the mind of the electorate. Increasingly, not only is it the economy, it's also immigration and the border, which tends to not go as well in the Democratic direction. A lot more voters give more credit to Republicans in the former Trump administration on those issues. So it's kind of going to be a balancing act, but certainly the abortion issue is going to be incredibly important.
Kaylee, just got about a minute left here. Some well-known big-name GOP donors have been backing Nikki Haley. New York Times, we are also on this about Donald Trump and maybe Elon Musk meeting and so on and so forth, whether or not Elon Musk is going to help financially. What do we know about this? And what is really more importantly, the financial fundraising that Donald Trump has done so far? Does he need some assistance? Does he need help from some of these big name donors?
Yeah. Well, on Elon Musk, Carol, he did post on X today that he's not going to be financially supporting either of these candidates, so maybe we take him out of the equation. And a lot of the other big money donors that threw money behind Haley are not shifting money to Trump, but have said they're going to be spending more down ballot in congressional races. So for Trump, it might still be trying to get those grassroots donations, but to your point on his financial difficulty here, he's going to need a lot of them because he's not just trying to finance a campaign. He also, to return to the legal question, is dealing with multi-front legal battles and multiple criminal and civil cases. Those attorneys are very expensive, and we have already seen a lot of the money his PACs have been raising go to paying those legal fees. So he kind of needs resources from two ends here to finance two different efforts when Joe Biden has a very large war chest at his disposal for this long general election contest, and he doesn't have to pay any lawyers.
All right, well, great to get the lowdown on this from you. Co-host of Balance of Power, Kaylee Lines, joining us there in our D.C. bureau. Coming up next, we'll get back to New York Community Bank. The stock still halted, so continue to track that one for you on this Wednesday.
Hey, let's stay in Washington, D.C. for a check of the latest world and national news. Amy Morris is in the Bloomberg 99.1 newsroom. Hey, Amy.
Hey, Tim, Republican presidential candidate Nikki Haley, as you were just discussing, has ended her run for the White House.
I am filled with the gratitude for the outpouring of support we've received from all across our great country. But the time has now come to suspend my campaign.
And interestingly, she did not immediately endorse Donald Trump. However, the Washington Post reports Senate Minority Leader Mitch McConnell says he will endorse the former president after years of acrimony between the two men. Federal Reserve Chair Jay Powell reiterated to lawmakers the central bank is in no rush to cut interest rates until policymakers are convinced they have won their battle over inflation.
It will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% objective for inflation is not assured.
The remarks echoed a consistent message from the Fed that the economy and labor market are strong. Skincare companies shares after a report detailing how acne products, popular ones from several brands, may contain elevated levels of benzene, a chemical linked to cancer. New York Governor Kathy Hochul is deploying 750 National Guard officers into New York City's subway system after a rash of violent incidents reignited fresh concerns about safety and security. Global news 24 hours a day, whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Shares of New York Community Bank do remain halted. They are down 42%. NYCB said today it received an equity investment of more than $1 billion, led by Stephen Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners. It is a developing story. Again, shares of NYCB right now, they are halted. Some of the other stories that we're following for you today: Bank of America, B of A, says investment banking will likely be up 10 to 15% year over year for the first quarter. That, according to Bank of America's chief financial officer. B of A shares right now up by 0.4%. A Senate hearing was told this morning Boeing officials have failed to fully cooperate with government investigators looking into how a panel door blew off a Boeing 737 MAX jet in January. Boeing shares trading lower right now. We've got Boeing down by roughly 0.4%. Wall Street traders certainly breathing a sigh of relief. A Fed Wednesday with testimony today from Fed Chair Jay Powell. S&P up 23 right now. We're off session highs, but up 0.5%. The Dow up 44, up 0.1%. The Nasdaq Composite Index up 99 now, up by 0.6%. 10-year 4.10%. The 2-year 4.55%. Spot gold up 0.7%. 21.42 the ounce. While West Texas Intermediate crude rallying 1.1%, 79 even a barrel. Bitcoin right now up 5.8% at 66,990 on Bitcoin. Again, recapping a trading halt for NYCB shares, or the S&P 500 index up 25 points, up 0.5%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Charlie reminding us that we are still awaiting the resumption. Oh, it does look like it is.
Shares of New York Community Bank higher by 30% as we speak. This after Bloomberg News exclusively breaking the news that the company plans to announce an equity investment of more than $1 billion, led by Stephen Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners. According to a spokesperson for the bank.
Stock shooting up in a big way. All right, let's get to Bloomberg News U.S. Deals editor Matthew Monks. He and the team here, he's in studio, but breaking it. Matthew, you've been working this story. Tell us about it, what we know, and how it all came together.
So, I mean, I guess the story at the moment is this 30% spike in the stock, which we just saw in real time as we're watching it.
Hitting
so I guess,
a limit. It sounds like.
But yeah, this is really something. So this, I mean, so the first statement is, yes, they achieved their immediate goal here, which is stabilizing things by bringing in some blue chip investors. Which my takeaway here is that is the main thing here. These guys know what they're doing. First of all, they're getting the equity, which whether they need that or not, I actually am not sure they need right now. They might need some regulatory capital down the road. But this is really about investor confidence in the firm as a going concern.
I was really surprised to see the news that just days after Sandro Danello became CEO. A new CEO is in, Joseph Otting, the former comptroller of the currency.
That's right.
The new CEO. What do you know about this?
I don't know anything about it, and anything I say would be speculation. I would say speculatively, you don't see these types of moves made so dramatically in such a short amount of time willingly, necessarily. So I think it's a safe kind of assumption or deduction that maybe this, one of the regulators may have been leaning on them to do this. I want to highlight that that is pure speculation on my part, and that's just because you don't see banks do such dramatic moves so quickly, or perhaps the other speculation, maybe this was a contingent. This is when the investors wanted something to happen. I don't know. It's all pure speculation, but it doesn't seem like you make that type of move without some kind of incentive.
As we said earlier, the stock was halted when it dove 47% at its lows today. It was halted again as it jumped 30%. Again, obviously the exchange monitoring some of these big moves here, the volatility that we are seeing just in one day in shares of New York Community Bancorp. You say that these are investors who know what they're doing. They're smart investors. Walk us through what they probably had to look at to feel confident about this investment.
So first of all, on the outside, they're seeing an opportunity to make a ton of money. This is a classic thing that you see during times of distress. You see private equity type investors go into banks. You saw this during the last financial crisis. You can make a lot of money investing in banks if you buy in at the right price. This guy Mnuchin, the former Treasury Secretary, he made a killing on IndyMac. It was an incredible deal. He got one of the first sweetheart deals. The dude knows what he's doing when it comes to banks. Like, seriously. So first of all, the number one thing is it's cheap. You're buying in cheap. And then let's look at New York Community Bancorp. All things considered, it's actually a really good bank. It's in New York City. Those multifamily apartment loans historically are bulletproof. You take a bank in New York City where you can get deposits. You have an asset that tends to hold up historically really well over time. On the outside of it, if you have the guts, it's a bit of a no-brainer decision.
$1 billion cash infusion, $1 billion equity investment. That's a lot of money, especially as Herman Chen noted, the market cap as of earlier today of the bank was just over $1.2 billion.
Yeah, but it's actually still quite small. I mean, but what is the asset size? It's about 100 billion asset bank, right? And then it was the market cap was 7 billion, like like 6 weeks ago. You know, in banking, it's actually not that big, but you know where the market cap is now, yes, it's sizable. But the main thing here, my takeaway, and this is me just talking from the seat of my pants, is it's about a sign of confidence. It's who these guys are more than anything.
And not just the seat of your pants, because you've got a quote in there from Stephen Mnuchin in your story. And what's interesting, you go back to March 1st, when we got this concern from New York Community Bancorp about material weaknesses from the company in terms of internal controls, not expected to impact 2023 results. That's March 1st. So here we are, they get the cash infusion, and you have Stephen Mnuchin saying very aware of their credit risk profile, but they've done the homework and they feel very confident, right, that this $1 billion will do the job.
That's right. And I'm assuming that they've had, so New York Community's troubles have been going on for a while now. This guy knows what he's doing. I mean, going back to the IndyMac thing where they had to sort out the mortgages, like he knows what he's doing. I'm assuming that they've been doing homework on this for a while. And there's only so many of these opportunities out there for guys like this.
Matthew, what do you know and what can you report about how a deal like this comes together?
I don't know. I mean, I'm just assuming that I really don't know, first of all. But you see, so Jeffries was named as an advisor there, so we're kind of, let's assume that Jeffries has been working on behalf of them, you know, evaluating a range of options. I also want to specify this is a no-brainer. Like this is like it looks cool on the outside. But this happens in bank. Go back to the financial crisis. You saw this all the time. Like Webster Bank raised money from.
But I think what's interesting is
exactly.
super
there's
basic.
A point where it becomes so beaten down that there's an opportunity.
Super basic move.
But we're not in a financial crisis.
No, we're
right
not.
now.
But
so,
whenever a bank is on distress, going to some private equity and selling some equity or preferred shares, it's like it's crisis 101. When I say crisis, I mean crisis for the specific institution.
You know, it's interesting. We've talked with our own Max Abelson about this deal, and that, you know, New York Community Bancorp was kind of long in coming in terms of combination of a couple of different entities, changes in law in terms of rent-regulated, you know, property. Does this kind of solve all that maybe has ailed and got New York Community Bancorp to this point?
No, this solves investors freaking out on Wall Street. That's what this solves. And you have to keep in mind, like the fundamentals of the firm and the trading of the firm are two different things. They're actually not really related that much at all, to the extent that it doesn't spook depositors and they start pulling their money out of the bank, which shouldn't be an issue with this bank, by the way.
Matthew, the other thing I think about, these investors, right, you said they're smart. They know what they're doing. Some of them have been here before. Stephen Mnuchin certainly understands how this game is played, but has seen maybe this playbook, if you will, before. Having said that, they're adding 4 new directors. I think they're also trimming back the overall board. Is there, though, should we assume that at some point, in terms of getting even more money back or getting their money back, that this bank maybe doesn't continue to exist in its current form? Are there things that are going to be sold off or just too early to tell at this point?
I think it's too early to tell, but like I think that the playbook here, this is just what we've seen before, is they're probably going to shrink down, sell some assets. I don't think they'll be selling branches, but they'll probably get out of some business lines, and they'll probably get smaller. But in terms of them as a go, like, you know, anything happening to the firm, I don't see that happening at all. And in terms of them becoming like an M&A kind of takeout target, that's not. I can go at great length into why we're not seeing a lot of that right now. For right now, that's off the table, unless the FDIC or someone made something happen.
Based on your reporting, your sourcing, is this enough cash to see a credit rating change?
Great question. I don't know.
We'll have to wait and see, I guess.
Wait and see. That's right.
Because
just got 2 credit down,
that's
major
right.
Exactly, and that's a big deal.
Yeah, exactly. And that's going to be part of the story going forward, because that certainly gets into interest costs, right, for this company. Well done. Is there, I don't know, a last thought here as we kind of wrap up?
Yeah, I just want to reiterate what I said about, you know, you have to keep the stock market decline in context against the actual health of the bank. They're two different things, and this really does take some pressure off of that point with investors kind of selling down the bank.
Yeah, interesting to see, as we said, another pause. Pause to the downside earlier today when it was down 47%. Stock now, it looks like up 18%, but as it peaked up a move of about 30%, we saw another halt in just the extreme volatility. Want to point out the SPDR S&P Regional Banking ETF, the KRE. It was down earlier today on concerns about this. It is up almost 1% here, so we're seeing some calmness. Great reporting, great exclusive. You guys broke it. You broke it. Bloomberg News U.S. Deals editor Matthew Monks joining us here in studio. New York Community Bank crypto certainly on our minds today.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Shares of NYCB were trading briefly. Right now we do have a trading pause as opposed to a trading halt. Shares of NYCB up by Bloomberg. So NYCB just about to resume trading. New York Community Bancorp did say it received an equity investment of more than $1 billion, led by Stephen Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners. Stay with Bloomberg for the very latest. By the way, the beleaguered regional bank also named Joseph Otting, the former controller of the currency, as its new CEO. Deutsche Bank has cut the bonus pool at its investment banking division by more than 10% after a slump in deals and a slowdown in trading last year. Sources say staff advising on mergers and acquisitions saw some of the deepest reductions. Foot Locker shares are plunging, down now by 31% after pushing back a plan to expand its sales to $9.5 billion by 2 years after a sluggish 2023. Nordstrom is forecasting muted revenue and comparable sales growth this year as sluggish demand at its high-end namesake stores offsets an improving outlook at its off-price rack stores. Nordstrom shares down now by 16%. And Abercrombie & Fitch reported fourth quarter earnings that topped forecasts, underscoring the apparel retailer's ability to maintain momentum despite uncertain economic conditions. The company has had 5 consecutive quarters of revenue growth, outperforming other American apparel companies such as Gap. Again, Abercrombie & Fitch shares, they are lower now by 4%. And those are some of our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
It is Bloomberg Business Week on this Wednesday afternoon. Hey, let's get a check on the latest world and national news. We got Amy Morris in the Bloomberg 99.1 newsroom in D.C. Hey, Amy.
Hey, Tim. Federal Reserve Chair Jerome Powell reiterating to lawmakers the U.S. Central Bank is in no rush to cut interest rates. He says they do have to get that timing just right.
Reducing policy restraint too soon or too much could result in a reversal of progress we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment.
The remarks echoed a consistent message that policymakers have time to wait before cutting rates. Republican presidential candidate Nikki Haley has ended her run for the White House, indicating she will not immediately endorse Donald Trump.
I have always been a conservative Republican and always supported the Republican nominee. But on this question, as she did on so many others, Margaret Thatcher provided some good advice when she said, quote, "Never just follow the crowd. Always make up your own mind."
And she congratulated Donald Trump for being the likely nominee. Daylight saving time starts Sunday. We'll lose an hour of sleep, but we will spring forward. However, a new study of more than 200,000 people finds lack of sleep is linked to type 2 diabetes, increasing the risk 41% in people who only get 3 to 4 hours of sleep a night. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Carol and Tim.
All right, Amy Morris, thank you so much. Carol Master along with Tim Stenovec here on Bloomberg Business Week, and continuing to watch shares of New York Community Bancorp. Looks like they're now, I think they're still halted.
Yeah, still halted. They moved around a bit, but still, this is what happens when there's so much volume and there's a lot of volatility. Right now, they're up by 4% after being halted at 18% after being halted at more than 27% earlier. So market makers trying to do their job on the floor of the New York Stock Exchange.
Which is why the volatility, we see these trading pauses. Quite a swing, though, down 47% before we got the news of raising over $1 billion in equity from a group of investors at its highs today, just after the news. And once the stock resumed trading initially, it was up almost 37%. But as we said, a lot of volatility causing some halts as we continue to track it. But nonetheless, it seems like at this point, perhaps the next chapter being written as the company moves forward from some of the concerns, some of the overhang, and some of the exposure, in particularly in terms of New York real estate.
Yeah, and
residential real estate.
That group of investors, including Stephen Mnuchin's, Liberty Strategic Capital, Hudson Bay Capital, Reverence Capital Partners. Other news coming out today, the bank also naming Joseph Otting, the former comptroller of the currency, as its new CEO. Otting replaces Sandro Danello, who became CEO just a few days ago, Carol, back on February 29th. Danello does remain non-executive chair of the company.
All right, quick check on the KRE, the regional bank index that we like to keep a track on. It's also kind of moved a little bit lower, just call it flat, a little bit lower, down about 0.05%. It had rallied a little bit earlier after that news on New York Community Bancorp.
And we are seeing shares of New York Community Bank trading again. They did move briefly negative. Now they're actually just kind of flat, up about 0.4%, but investors trying to make sense of this, up about 2%.
Semi-gainers list for when we get to
so
it might be a little sketchy here.
Be flexible. That's all I'm going to say.
All right, a busy Wednesday. New York Community Bancorp, yes, up about 1.5% here. On a day when the S&P is up about 20, the NASDAQ is up about 79 points here. Coming up, we're going to continue to track New York Community Bancorp, see what it does in that last hour of trading. Also, get into a hidden crisis, one of the most read stories on the Bloomberg that is brewing when it comes to U.S. housing. Tim and I are coming back here on radio. This is Bloomberg.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
All right, everybody, we are just 1 hour away from the closing bell. Welcome back to Bloomberg Business Week on radio, YouTube, and Bloomberg Originals. Carol Master along with Tim Stenovec. Certainly top of mind is New York Community Bancorp trading once again. Stock just up about 1.5% here, Tim.
Yeah, we're going to keep an eye on this throughout the day. We did see it halted for volatility, both to the downside and to the upside today following that news. This is Bloomberg Business Week, live in the Bloomberg Interactive Brokers studio. Still ahead, Carol, a hidden crisis brewing in U.S. housing. We're going to take you to what could be ground zero of the next sweeping financial crisis.
Yes, indeed. This is one of our most read stories on the Bloomberg, plus a group of stocks on the move on the news that acne treatments are joining the list of widely used consumer products found to contain a chemical linked to cancer. So that's front and center as well.
All that and more over the next 2 hours. First up, though, a check of the day's trade and top business stories. Here's Charlie Pellett.
Hi, thank you very much. 1 hour to go ahead of the closing bell. Stocks do remain higher. We are off session highs. Just want to update you on NYCB. The stock up and trading right now. Shares are now down by 2%. So NYCB moving lower, down now by 1.7%, certainly bouncing around. But the news out of New York Community Bank, it did get an equity investment of more than $1 billion, led by Stephen Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners. But right now, shares of NYCB, they are back in the green. Certainly a lot of volatility right now, trading higher now by 2%. Stay with Bloomberg for the latest on NYCB. It is an up day for the Dow, the S&P, and NASDAQ. Traders breathing a sigh of relief with Jay Powell once again signaling that while a strong economy will keep officials on hold for now, he does expect the Fed to cut rates this year. S&P up 19 at 5,098, up 0.4%. The Dow up 18, up less than 0.1%. The NASDAQ Composite Index up 73, up 0.5%. 10-year 4.10% with a 2-year right now 4.55%. Spot gold trading higher by 0.7% at $2,143.76 on spot gold. West Texas Intermediate crude up 1%, 78.93 a barrel, and Bitcoin now up by 5.5%, 66,853 on Bitcoin. So bottom line, Fed Wednesday, stocks higher, S&P again up 0.3%. As for the market backdrop, Kate Moore of BlackRock Financial Management told us she remains focused on fundamentals.
Inflation and Fed policy and parsing all of the speeches is going to be what we do for hours on end. That said, we really have to focus on what companies can perform in this economy in order to make money.
And you can hear more of the conversation on the Surveillance podcast. Again, NYCB up by 0.3%. I'm Charlie Pellett. That is a Bloomberg Business Flash.
Hey, thank you so much, Charlie. Do appreciate that. Well, here on Bloomberg Business Week and at Bloomberg News, we follow foreign direct investment very closely because each year, countries around the world compete for more than $1 trillion in FDI flows. Multinational corporations must weigh the shifting landscape, the evolving risk-return profile of countries, while governments and international trade bodies lay down foundations and incentives to compete for their investments.
Maggie Switek is Senior Director of the Milken Institute's Research Department. She focuses on access to economic opportunities in the U.S. and around the globe. She joins us from Santa Monica, California. Maggie, great to have you here. A busy day, but we did want to include your report that you've got, a new report about the most attractive countries for foreign direct investment. And what struck us is that they are all advanced economies. Just briefly go over kind of some of the key findings here.
Yes, absolutely. So in the report that we just put out, we use our Global Opportunity Index. So what the Global Opportunity Index really does is that it provides a benchmark for countries' attractiveness to international investors. And the way we do it is we use 100 different indicators that we classify into 5 different categories that are business perception, economic fundamentals, financial services, international standards and policy, and institutional framework. And so in the report itself, we pair the findings from the Global Opportunity Index together with capital movements around the globe. And what that does is it really provides a comprehensive overview of opportunities for investors outside of their local markets, as well as it provides information to countries that are interested in improving their business environments by letting them see, what are the factors that they could work on in order to become more attractive to investors. So what you mentioned there is that the countries that tend to perform among the top 20 are all advanced economies. So this is actually something that is not surprising.
I was going to say that seems to be expected, right? We think, because in terms of all those metrics you laid out, it's interesting. Here we are focused on New York Community Bank Corp today, and there has been lots of concerns surrounding this bank over the last few weeks in particular, and the last week in particular, and yet, there are the means often sometimes from investors to kind of help out the situation. And I think about in the developed economies, that is available versus some of the emerging economies where that's not likely or as easily done.
Yes, no, and so absolutely. These countries, these top 20 countries in our index, they're really strong in institutional framework. They have a good business perception, which, again, as you mentioned, is not surprising. These advanced economies really do attract the majority of capital inflows. They attract around 65%, our top 20 countries, of capital inflows from around the world. So it's also not surprising, again, as you mentioned, that they're on the top. However, what we say in the report and what we also highlight is that in addition to paying attention to these advanced countries, which are increasing their attractiveness as interest rates are remaining high among the advanced economies, investors should really also keep a lookout on the emerging countries and emerging and developing regions. And the reason why is because those offer, well, two reasons. First of all, they can offer high growth returns.
Right.
And also at the same time, these are countries that really need capital, right? These
so
are
that's what I
countries
want to
that
talk
could
about.
use this
That's exactly what I want to talk about, and sort of the idea of the risk profile. So if we remove some of the criteria that you include, but only look at where there's a potential for a bigger return for these investments, how does that profile change when it comes to advanced economies versus not advanced economies?
So definitely among the non-advanced economies, that's really where the growth is still remaining. So we see a lot of investment moving nowadays into Latin America, especially in 2022. So we know that emerging and developing Asia is really the region that captures a lot of the capital inflows in general. However, in 2022, we saw a movement of capital a little bit out of emerging and developing Asia and into Latin America. And there's really a lot of growth potential in Latin America. And when we talk about Latin America, there's really two countries that stand out. It's Mexico and Brazil. Right? These are the two major economies in Latin America. However, there's also other countries such as Chile, which is a slightly smaller economy, but still a considerable economy in Latin America.
Hey, Maggie, one thing I want, and I'm glad you talked to Latin America, because we've certainly spent more time here at Bloomberg focusing on what is happening there in terms of investment opportunities. Having said that, we spend a lot of time on another country economy that is so important to global growth, and that is China. And we've done a fair amount of story about investors not so keen to be putting money into that country. What can you tell us on that front? Because when we think about China, right, the second most important economy to global growth.
Yes, no, and so China actually continues to score high in our index. It scores at number 39. We're considering that it is still an emerging and developing economy as classified by the IMF is relatively high. In China, we have still a very strong innovation economy that is continuing to be paying off. However, what we did see, and exactly what you're saying, is that in 2022, for the first time in a long time, capital inflows into China became negative, which means that more money left China than entered. So that is what we are seeing there. So when we think about the factors that really are strong in China are financial services. They have a very developed or relatively developed for an emerging nation financial services sector, and precisely this innovation economy, which tends to prop it up in its institutional framework.
Right.
However, innovation, as we know, has been in the past observed to be stifled by excessive government intervention. So to the extent that that becomes an issue in China in the long term, investors can anticipate that and start moving their capital out.
Right.
However, what I want to say is also this is something that we're observing right now. Whether or not this continues into the future, that is another question.
All right,
yes.
we're going to leave it there. Maggie, thank you so much. Maggie Switek, she's Senior Director at Milken Institute's Research Department, joining us from Santa Monica, California. All right, folks, just want to rehash what's going on with New York Community Bancorp as we have about 50 minutes left in the trading session. Stock has been all over the place, a lot of volatility. It looks like another trading pause, but the stock right now, or at least the last trade, looks like it was up about 4% here.
Just to rehash what we've been updating, Bloomberg reporting before the bank coming out
trading
saying
again.
It is trading again. Look at that. It's up 8.5%. So we've seen several volatility pauses. Shares now moving lower, but still up 7.6%. The company received an equity investment of more than $1 billion led by Steve Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners. Once again, shares trading again. They are up by 6.2%. This after being as high as more than 30% earlier in the session.
All right, so keeping an eye on that. Quick check on the markets for you folks. S&P 500 up just about 23 points, up about 0.5% here. And if I look at the NASDAQ 100, just up about 0.6%. So a little bit higher in the trade. A lot of news, as you know, including on New York Community Bancorp. And of course, we kicked it off with Jay Powell testimony for several hours earlier today. Do want to point out that the SEC making some moves when it comes to greenhouse gas emissions and what companies must disclose for the first time. Right now on Bloomberg TV and radio, the chair of the SEC, Gary Gensler, with the hosts of Balance of Power, Joe Matthew and Kaylee Lines.
Greetings to our TV and radio audiences worldwide. I'm Joe Matthew alongside Kaylee Lines in Washington, D.C., and a pleasure to welcome the chair of the Securities and Exchange Commission, Gary Gensler. Welcome back to our Washington bureau here at Bloomberg. It's good to see you today.
Great to be with both of you.
We're looking forward to a conversation today about the climate disclosure regulations that you're unveiling. I have to ask you first about New York Bancorp with some of the drama that we've seen over this past week amidst filing concerns about commercial real estate fallout. Are you monitoring this? Is there anything you can do to protect investors here?
Well, I think your viewers would understand that in the role I'm in, I'm not going to comment on any one registrant or filer, but many banks are public companies. Those banks need to make sure that they make full, fair, and truthful disclosures to the public so that the public can make their investment decisions. I know we're going to be talking about climate, but it turns out it's connected. They need to make those disclosures that investors take investment decisions on, and make sure they have proper controls to make those disclosures. And but I don't have anything more on this one bank.
But just broadly, you're not concerned about systemic risk that might be emanating from commercial real estate?
Again, I'm not going to comment on one bank and so forth, but
broadly speaking.
Broadly, at the SEC, we are always monitoring markets for systemic risk. And the reason is because investors get harmed when one bank or one non-bank, it could be a bank, it could be a hedge fund, that fails and spills out into the market. I've been it ain't my first rodeo. I was even in the Clinton administration when long-term capital management failed. I was in the Obama administration when we were, cleaning up after the 2008 crisis. And it's always the American public, both investors and issuers, that get hurt. So at the SEC, we do monitor for systemic risk in our remit. And then we work with Secretary Yellen and Chair Powell and share our thoughts.
So to return to this question of disclosures, and this gets us to the news out of the SEC today, you have adopted now climate disclosure rules that have been significantly watered down from what was initially proposed. Scope 3 has been removed. For Scope 1 and 2, companies are essentially going to have to decide whether these climate risks are material to them. It's a pretty significant change. Why not repropose it by just adopting it today rather than opening it back up for comment? Have you opened the SEC up to more scrutiny and potentially more litigation that could come from this?
Well, let's just step back for your viewers just for a moment. What we have here is that today, literally hundreds, maybe 1,000 companies already today are making information about climate risk available to their investors. They're often doing it on the internet. There's sustainability reports and so forth. What we did today is we adopted a rule We hadn't had a rule previously. And we said these disclosures need to be in your filings, in your annual reports, in your registration statements, if material. That's consistent with 5-7 decades of what we do. Materiality is the benchmark. It's investors get to make the investment decision based upon the material disclosures. In this case, climate risk is something investors want to know about. Hundreds of companies are already making such information available, but this will give it more reliability.
What's the cost involved here for companies that will be new to these disclosures? Typically, critics point to red tape beyond the politics here. Red tape and increased costs. You actually have a sense of this already for those that are disclosing, and I suspect from the comments that you received, particularly companies that are just making the threshold. I know you have carve-outs for some smaller publicly traded companies, but what would be the additional cost of this due diligence? Could you put a number on it?
So we lay this all out in this release. It's over 800 pages if you want to have some weekend reading. But we really based cost estimates on what commenters had given us. And you asked, we got 24,000 comments on this. And in terms, it depends on the issuer. If an issuer actually determined that it's not material to their investors, the cost would be probably quite low. But if they determine that, for instance, to inform their investors properly that greenhouse gas emissions are material, then the costs go up. But again, in the release, it was measured from a couple $100,000 per issuer to, I think, upwards to high six figures, but still in the six-figure range per issuer.
But leaving it up to the issuer to decide whether this is material, could this actually result in less disclosure around climate-related risks, not more, to avoid incurring some of those compliance costs?
Well, what's interesting is if you look at the Russell 1000, the top 1,000 companies, some surveys show that already 90% talk about climate somewhere, climate risk, and about 60% put out something about these so-called greenhouse gas emissions. And they're already doing it because investors want to get that information. But again, our history, our remit is about that which is material for investors. And that's what we're doing here. And we're climate risk agnostic. And if more companies make this disclosure or fewer make the disclosure, it's about materiality. But I would say what we did today is important because it will bring some consistency and it's a real rule.
Kaylee referenced the potential for legal action here. I suspect that you've
it's part of our democracy.
Put some time into this, indeed, and obviously legal challenges are already being planned. There are 9 states being led by West Virginia at this point we've heard about. But I wonder, when you consider this, and you've been down this road before, is it governments? Is it corporations? Is it environmentalists who will bring the legal challenges to the SEC, or is all of them?
I think that at the SEC, we endeavor to do things within the law and how the courts interpret the law. And so we take the economics into consideration. We take these 24,000 comments into consideration. And of course, we take in another law. It's not the securities law, called the Administrative Procedures Act, how we do rule writing. I feel quite confident that we've done something within the congressional mandate. And why is that? It's because we're a disclosure agency, and that's all we're doing here. Companies already, 1,000+ companies are already putting out some climate risk information. Investors are already making decisions, and we're saying grounded in materiality, put it in your filings, and be consistent with what you're doing.
On the subject of consistency, though, if you're a big multinational company, the SEC rules are now what they are. California's rules, Europe's rules are significantly stricter. How is this supposed to work if you have to answer to multiple jurisdictions?
Kaylee, it's a very good question. They have different authorities. We're a securities regulator. Europe passes a law through their European Parliament that had a goal to manage the environment. California, similarly, through their legislation. That's not what we do. We stay within our we stay within our chalk lines, if I can use tennis.
Staying within the SEC's chalk lines, despite conversations that you're having today around climate risk, you also, I'm sure, as a 5-member commission and as the staff are going to be considering in recent months, because you are facing a deadline coming up in May around a spot Ethereum ETF.
It is, Kaylee, you had to get your
have to ask this
in.
question. Of course, we are now about 2 months into a world in which spot Bitcoin products exist. They have had incredible demand, more than $8 billion in inflows. Now the optimism is Ether spot ETFs are next. Do you not first have to settle the question as to whether Ether is a security or a commodity? Can you answer that first?
Well, Kaylee, again, on any one of these crypto tokens, it's about the facts and circumstances as to whether the investing public is anticipating a profit based on the efforts of others. But we do have filings in front of us. I'm not going to comment. I will say this is a highly speculative asset class. One could just look at the volatility of Bitcoin in the last few days. And look, I grew up loving roller coasters. Maybe in my adult years I don't ride them as much, but you really should be conscious as the investing public that this is a bit of a roller coaster ride on these volatile assets. And then the question is how firm is the foundation of the, you get to the top of that hill, how's the foundation underneath it? And are there cash flows, or what's the use case? For thousands of these tokens, there's about 15 or 20,000 of them, they also may be securities because the investing public is relying on the efforts of some group of entrepreneurs in the middle of these projects.
And would you consider Ether as part of that group that may be securities?
I understand you're asking the question, but again, I'm going to defer on that question.
All right, SEC Chairman Gary Gensler, thank you so much, as always, for giving Bloomberg Television and Radio your time, and we'll send it back to you.
All right. Kudos to Kaylee for pushing a little bit there.
I think he knows by this time if he's going to talk to Kaylee, she's going to be asking about that, because that's not the first time she's asked that question. Not the first time he said he's going to defer either.
Well done, though, to both of them. That, of course, was the chair of the SEC, Gary Gensler, with the hosts of Bloomberg's Balance of Power, Joe Matthew and Kaylee Lines, having to do with the SEC forcing companies to disclose their greenhouse gas emissions for the first time, watering down, though, a key requirement after some heavy lobbying from some industry groups. But you can read more. Just head to Bloomberg.com.
Yeah, he did say that the new climate disclosure rule is in the agency's remit, and that climate risk is something investors do want to know about. Hey, let's get a check on the trading day, because lots happening on this busy Wednesday. Here's Charlie Pellet.
Thank you very much indeed. The Dow just turning negative, but he alluded to roller coasters. Speaking of which, we got NYCB halted again. NYCB shares are up 9.3%. New York Community Bancorp said it received an equity investment of more than $1 billion, led by Stephen Mnuchin's Liberty Strategic Capital, Hudson Bay Capital, and Reverence Capital Partners. The beleaguered regional bank also named Joseph Otting, the former controller of the currency, as its new CEO. Stocks bouncing around. Right now we have got the Dow Jones Industrial Average lower by 2 points. Little change right now, giving up earlier gains. The S&P higher by 15, holding on to a gain now of 0.3%, while NASDAQ is up 57, a gain there of 0.4%. 10-year 4.10%, with a 2-year 4.55%. Spot gold up 0.8%, 21.49 the ounce. West Texas Intermediate crude up by 1%, closing in on $79 a barrel, 78.95 right now. And Bitcoin up 6.3%, 67,330 on Bitcoin. Among today's stock outperformers, CrowdStrike Holdings. After earnings, it did give a forecast for revenue and profit in the current quarter that far surpassed Wall Street's expectations. Right now, we've got CrowdStrike shares advancing by just about 9.6%. So again, recapping the Dow, the S&P and NASDAQ all higher. S&P up 16, now up 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. Really do appreciate it. Shares of companies that make popular acne treatments falling today. This after an exclusive report from Bloomberg News said that some of these treatments were found to contain high levels of benzene. It's a chemical linked to cancer. Bloomberg News healthcare reporter Anna Edney has spent years on this beat. She's working with an independent testing lab and has worked with an independent testing lab to identify the contaminants in consumer products. She writes today about the latest findings. She joins us from Washington, D.C. this afternoon. Anna, good to have you with us. As soon as this story crossed and I saw this redhead on the Bloomberg terminal, I said, I know this is Anna Edney, because when there's benzene found in something, Anna Edney is the person who finds it. It's not just when it comes to acne treatments, Anna. I mean, this lab has found this stuff in hand sanitizers, sunscreens, and dry shampoo in the past. What did you and the team find out about these acne treatments, and which ones are affected?
Yeah, well, I'm glad I can bring these happy thoughts immediately to your mind. But the acne treatments that this independent lab, Valisure, looked at that we wrote about today are ones that contain a pretty widely used ingredient, benzoyl peroxide. So those come from brands like Proactive. Target has their Up and Up store brand, Clinique, and Walgreens, as well as their store brand. Valisure testing found elevated levels of benzene in all of these products. And they did some initial testing, and they found about 9 times the FDA limit, which is 2 parts per million of benzene. And when they did some stress testing, those levels in some of these products rose to more than 1,700 parts per million. And benzene is a really potent carcinogen. It can cause cancer, particularly blood cancers like leukemia.
From an investor perspective, we talked about shares of various companies. You mentioned Clinique, which is owned by Estee Lauder. Estee Lauder's Clinique brand accounts for about 30% of total company sales. Jefferies already weighing in and saying that they will likely see significant damage to its brand perception. They put out a report because of Clinique's acne product among some of these skincare treatments that were included in this independent testing lab and what they are seeking from the FDA. Having said that, I have to say, Anna, this is a conversation I have with our makeup room, and just you and I have talked about it, Tim. There's a lot of products out there that are used either, makeup, skincare, and so on and so forth. Like, what is the oversight by the FDA? It feels like it's very loose in terms of ultimately oversight.
Very loose is exactly the way to put it. The agency has oversight of sort of the traditional drugs we think of, and also a lot of these beauty products fall under their umbrella, and they do not really do their own regular testing for contaminants or to make sure the products work like they should. They rely on the companies to keep up with the quality of their products and to tell the FDA if something goes wrong. So that's why here you're seeing this lab kind of step in and fill this gap, and suddenly all of these findings are coming up I think a lot of people, I think the average American might think that the FDA would kind of be looking for all the time.
Anna, how does benzene end up in these consumer products? Because it's not that these companies are necessarily putting this ingredient in, right? This is a byproduct that happens during manufacturing. I mean, correct me if I'm wrong here, but tell us about how this gets in.
Yeah, you're right. And it's actually coming from a lot of seemingly different places. No manufacturer would put benzene in a product. That would be crazy to add a known, very potent carcinogen to something like this. But so for the sunscreens, the dry shampoos, some antiperspirants that Valisure found had benzene in the past few years. That benzene is coming from the propellant. They're usually aerosol versions of those products. And a lot of those products use propane and butane to spray, help spray the goods that are in the bottle out. In this case, it's a little different. Valisure believes that their testing shows that the benzene was formed when benzoyl peroxide breaks down over time. So essentially, the active ingredient in these products is unstable, and it can break down and cause the product to have benzene in it. And that's why you see the increasing levels as Valisure stress tested it, because over time, then under certain conditions that benzene is growing inside of the product. So the lab has asked the FDA to recall these products and sort of investigate what's going on if potentially the whole kind of class needs to come off the market.
So one thing I want to, forgive me if it's a curveball, but over in Europe, where there tends to be, I feel like, a lot more oversight over products that directly could impact consumers or that are used by consumers, are there, I don't know, are these companies allowed to sell products with benzene?
No, nobody's allowed to sell products with benzene, except in the U.S. There is this 2 parts per limit that the 2 parts per million limit that the FDA has set. Interestingly, when you look at the actual guidance, and this is getting really wonky, but if when I'm reading these things, I see